morning saying this: equities can still work in a higher rate environment. The S&P 500 returned 15% year on year from 85 to 2005, with real rates at 3.5%. Jack Manley, how much of a challenge is there from real rates in this bond market to stocks at the moment?
Well, we have to acknowledge, right, that where rates are at the moment is certainly a greater hurdle for equity investing than where they had been just a couple of years ago, right? Stock investors are going to need a little bit more out of the stocks that they're investing in to justify taking that additional risk. But, you know, when I look at the equity market right now, I could absolutely see this market continuing to trudge higher despite that higher rate environment. I think what this points to, though, John, is the need for a quality overlay in portfolios. You know, money's not free anymore, and I think that even when the Fed does pivot and ultimately move rates lower, it won't be taking those rates back down to zero anytime soon. Businesses are going to have to be a whole lot more thoughtful about how they're allocating capital. Investors, in turn, are going to have to be a whole lot more thoughtful about how they're allocating capital. I'm not trying to make a style bet right now. I'm saying quality, and frankly, I think this is just a heck of an opportunity for active management as well. That's how I stay constructive despite the rate environment.
Jack, what is quality? What would you point to at the moment?
Quality right now to me is consistent, dependable earnings, right? Of course, there can be some sort of cyclicality in there. That's always going to happen. Booms and busts in the economy will translate into booms and busts in earnings. But that stability, that dependability, able to generate earnings day one as opposed to something that may be coming our way 5, 10, 15 years down the line and something more speculative, more growthy. That to me is what quality looks like.
Seema, what's your take?
Very similar to what Jack's just said. You know, we're not thinking really about styles. You want to think about pricing power. Inflation is coming down. Even if it were to pick up a little bit, we're not looking at what we saw at the start of this year. So companies are going to be under pressure. So you need to have big names, big balance sheets, things that can deal with this higher rate environment, which seems like it's likely to persist for longer than certainly what we've seen over the last 10 or 15 years.
Do you think this stock market, Seema, can live with 5% interest rates on a 2-year, on a 10-year at 464? And with real rates through 2%?
So look, I think the jury is definitely out on that one. You know, if you're talking about the Jamie Dimon 7%, no, I definitely don't think equities can live with that. I think that something would certainly break. The thing with bonds is it's really the speed of the move up. How disruptive has that been? It has been a very, very significant and sharp rise, and yet equities have digested it. So I almost feel that they have gone over the hurdle. And from here, as long as you're not going to get the Fed moving up significantly further from here, I think as long as growth is there, then equities have got a little bit further to go.
Move in bonds has been phenomenal. Move of more than 70 basis points on the quarter. 4 weeks now. 4 weeks of yields higher on a 10-year, up by about 7 basis points right now at 464. And 4 weeks of equity weakness on the S&P 500. Longest weekly losing streak of the year so far as we kick off Q4. About 20 minutes away from the opening bell. Equity futures here down by about 0.35% on the S&P 500. Jack Manley, Seema Shah are going to stick with us. Let's get you some movers going into the open. Here's Abby.
Well, weighing on futures this morning, John, is certainly what you mentioned earlier with Tesla, with that bit of a delivery miss. The stock right now is down nearly 4%. And this, of course, as their deliveries for the third quarter came in a little bit above 435,000 and well below consensus at 461,000. We'll be digging into that a little bit more on the open. As for NVIDIA, though, we have some strength. And for Coinbase, too, we, of course, have Bitcoin up more than 4%. And in addition, we do have Coinbase winning a Singapore license, so the stock surging there. And then NVIDIA off of its highs, but nonetheless, it was upgraded to a conviction buy from Goldman Sachs. So we do have a little bit of a bounce there for NVIDIA.
Abby, thank you. We'll catch up with you around a cash open in about 20 minutes' time. Coming up, Congress avoiding a shutdown.
Congress passed a spending bill that's going to keep the government open. And it's good news for the American people because the government.
Delta Airlines is committed to net zero carbon emissions by 2050. Because we know a thing or two about getting where we need to be. And it's time we all got going. Together.
Okay, good evening, everybody. Let's go ahead and get update our journal. So let's go to the COT report journal. As of this morning, we were up 575 pips. Also, just a little GWiz factor. I actually stopped out on my MT4 account of one of these trades. Let me see which one it was. I stopped out on my FX trade, which is where I'm tracking my signals. All 6 are still open, but I did stop out of which one? I'm pulling it up here. I stopped out. Let's see if I have CAD franc again. Euro CAD, Euro yen, NZD yen. So NZD CAD. Yeah, NZD CAD I closed out. When I say I stopped out, I hit my trailing stop on that trade. Let's see, orders activity. Oh, I just want to see. Oh, that's just activity of units. Let's see, does this show me? Huh, this is not showing me that. Okay. Anyway, I need to check to see what it actually made or lost, but that one did close. I just want to make sure everybody's clear because I'm sure for those of you trading on MT4 that happened. And the reason why is because this trailing stop's a little tighter, right, than it is on just the normal trailing stop that I use on my FX trade. So that might be the reason why you might see that. So anyway, but nonetheless, I do want to update these current trades that I have open here. Come on, let's just close that and do that again. Okay, so let's do this quickly so we can move on. So the CAD franc is my first trade. I have 12 pips on that right now. Franc yen, I'm up 163 pips right now, 163. And Euro yen, wow, that one really took off. We were up 157 pips this morning. That one's now up 241 pips. Wow. Euro CAD, I've got 105 on that one. NZD JPY, I've got 159. So that one's improved as well. And then NZD CAD, I'm currently up 78. So that one's the only one that did not improve. So we went from 575 pips this morning to now, if we were to close everything out, we should be up. Not everybody's going to be exactly the same, but approximately everybody should be around 758 pips of profit, which is really exciting. And I just want to highlight one thing. I'm sure we're going to talk with Ben about this concept. This is one of the observations he made, is the concept of being patient and holding, right? So think about that. Like, yesterday we were up quite a bit, and then just overnight the trades improved drastically to we were up 575 pips. Now we are up 758 pips just by holding. So an extra, we'll say 200 pips ish. We're up 190, 180 pips just by holding another 9 hours, right? So I think it really goes to show the concept of having patience. A lot of times it's really easy for us to see these types of profits come in, and all of a sudden it's like, oh, I got to close this. I got to take this profit because I haven't seen profits in a while, so I got to take this, right? And I shared this morning one thing that I do to kind of fend off or kind of satisfy my natural craving, which is to take those profits, right? Every single one of us wants to take those profits when they come in. And so one of the things that I do is, as long as for me, as long as my trailing stop is in, I'm okay, right? Like, obviously every single one of us would like to book as much profit as we humanly possibly could, right? But that's not always going to happen. It never is going to happen, right? So the trailing stop for me is that satisfaction of knowing, hey, let's let this thing go, and as it continues to go, I'm locking in more of that as it continues to go up. But when it finally pulls back, we might give up a little bit of that cream at the very, very top, but at least we made all of this in between, right? That's kind of the idea with the trailing stop. So I just think it's interesting. Again, last night, you really would have sold yourself short on a really good week. And it is important to have really, really good weeks with the COT report, because there will be bad weeks. And there will be weeks where you're going to be like, why did I take these trades? This is terrible, right? That's going to happen. Mark my words. If it hasn't happened to you yet, it will happen, which is why we need to have some really, really big, fantastic, phenomenal, just outstanding weeks where that money comes in. All right. So anyway, I talked about that. We'll talk about that more later. What I want to do is, for those that are watching the recording or who are new to the COT report, I do want to make sure that we cover how this strategy basically works and where it came from. So let's jump into that. And again, please stop me if you have questions. Just type those questions in the chat box and I can answer those as we go along. So about 4 or 5 years ago, I ran into the COT report when I was working for another trading company. Not because that company was trading with the COT report. It was actually just through my own research. I just hopped on YouTube one day, and I was just searching, Forex trading strategies, just like everybody else does. And I found this guy that was trading the COT report, or at least using the COT report as another set of confirmation for the trades that he was taking. And I got really interested into it because it was a way to navigate what the institutions were doing, and it didn't cost any money. It was free information, right? So if you go to cftc.gov, this is where you find the COT report, and it stands for Commitment of Traders. And when you're here, this is what their homepage looks like. And there's obviously a lot of different things you could go down, rabbit holes you could go down, but specifically, we're going to look at this one that says Commitment of Traders. It's found under the Market Data and Economic Analysis tab, right, or ribbon up here. So now we're going to click on this. It'll take us here. And then there's going to be a lot of different COT reports that you can look at. The one that we really focused on is this one, which is called the Current Traders in Financial Futures Report. So we're technically looking at a report that's in the futures market. Even though we don't necessarily trade futures, the contracts that we're viewing are very much applicable to Forex trades and can be used to profit in the Forex market, right? So if I click on this and click long format, it's going to pull up this very boring report. This is a COT report, and this is the COT report we use every week. And when you click on that link every week, it will pull up the most up-to-date or updated COT report. Just so everybody knows, the government releases this report every Friday at 4 p.m. Eastern time. So if you want to mark that on your calendar, you can do that. Now, this COT report comes out on Fridays. However, they collect the data from the Chicago Mercantile Exchange and other exchanges on Tuesday. Now, that may sound like a delay, and it is a delay. It's unfortunate. It's an unfortunate delay, and sometimes I wish they could get their act together and report this a little bit faster, but that's what we have to deal with. So it is a little bit of a delayed, what I guess you could call it a delayed indicator. However, a lot of the times when the banks build positions, it's not one of those things where it's like, oh, we're building a position today or next week or next month. Sometimes these banks will build positions over several weeks at a time, sometimes several months at a time. And so just because this is a few days delayed doesn't mean it's information that couldn't be used. It's definitely very, very useful information, and we've proven it to be very useful. So I like to zoom into it, and I just do a Control Plus because it's really hard to see with your eyes unless you zoom in. So I like to do that, and then I just do a Control F to navigate where I want to go. So if I wanted to look at the Australian dollar, I just search AUD, and that's going to take me to the Australian dollar. And when I'm here, you'll see that there's different participants on the COT report. You've got the dealer side, asset manager side, and the leveraged fund side. So this was actually a battle for even just a year or two. I was trying to figure out who's the best, or what would be the best participant to be looking at, because when they publish this report, there's different types of traders out there. There's traders who are hedge funds. There's traders who are dealers, commercial traders. You have non-commercial traders, asset managers. These are people who manage funds for a lot of school districts and pension plans, things like that, right? Asset managers. And then there's leveraged funds. Leveraged funds, from what I've discovered and through my research and through the people I've had conversations with, is probably the best place to be if you're a Forex trader. Because if you look up the details and the description of a leveraged funds trader, these are people who take what are called outright positions. It's an actual financial term in the COT report. And they take these outright positions with the intention of making a profit. So they're trying to basically speculate where the market's going to go. And their sole purpose is to make money, nothing else. They're not trying to hedge the market or use the Forex market or futures market as a derivative to hedge their other assets, to hedge like an asset manager might hedge with the currency market or futures market against maybe some other assets that they hold in their portfolio, nothing like that. So leveraged funds are just traders who are specifically just out there they're the wolves, right? They don't care where the market goes. They literally don't care. All they care about is just making money, which is us, right? That's what we want to do. We want to make money, right? So these guys are pretty dang good. As you know from this week, they're pretty dang good. They're really accurate with the trades that they take. Not every week they're going to be accurate, and some weeks they're going to be, switching directions. So I do want to make clear that, sometimes we're not going to get it right, because then it's not like they're not God, right? But they are pretty good at what they do, and they've been doing it a long time. So we might as well follow the people who are pretty good at it, right? So basically what I look at when I'm looking at leveraged funds is I want to see the amount of long positions they have, and I want to look at the amount of short positions they have. I also want to look at the change in positions from week to week. So basically what I do on the weekend is I grab this information, right, from the long side and the short side and the change, and then I plug it into my journal, which is right here. Okay. And I put in the long positions, the short positions, and I also put in the change right here. The rest of these numbers, so these numbers right here that you see, these are just derivatives of whatever I inserted right here. So what I want to know when I put it in this journal is I want to see what's the percent long, what's the percent short. So of all the positions on the Aussie, what percent is long and what percent is short, right? That kind of information is really important to me. Same thing with when I'm looking at the change. I'm really curious to know from the previous week, how much do they add long or how much do they add short? This can be very helpful in determining which direction to go. So like if you look at the franc, you can see that there was a pretty substantial net change from the previous week, 14% net change. You can see the euro actually had a net change long, and they already are long, which is great. You can see let's see, what else do we have here? The CAD went short, minus almost 7% short. And in addition to that, they already were trending short, right? Because this is what their current holdings are. And they were basically heading the short direction. So this week, I would say you had pretty substantial signals because a lot of stuff, just the stars aligned, right? Like everything just kind of came together. Now, the way I trade this and the way I've been trading this the longest, because I've traded different versions of the COT report. In fact, if you were to talk to me maybe a couple years ago, I used to only trade non-commercial, which is another subset of participants. I didn't trade leveraged funds. In fact, it wasn't until about probably a year ago where a friend of mine who trades the COT report said, dude, you gotta trade leveraged funds. That's where the real speculators are trading, and that's where you're going to get the most accurate week to week signals. And so I did, and yeah, it definitely had better results. So that's why I kind of went the leveraged funds way. Anyway, that's a whole nother story. We can talk about that another time. So okay, so anyway, so what I do is I take, for those that are new, for a lot of you, this is old hat, so I'm kind of going quickly. But what I do is I I analyze this information and I want to find the strongest currency of current holdings, right? So I want to find who's the most bought currency, or the top 2 or 3 most bought currencies, and the top 2 or 3 sold currencies. And I've highlighted those in green and red here. And then what we do is I take the top bought currency and I'm going to pin that top bought currency against the weakest currency. So for example, this week, the franc against the Japanese yen was the best combination. So you had the most bought franc against the most sold yen. So the best option would have been the franc yen. And then all these other ones followed. So you had the CAD, which was pretty short, against the franc. That was going to be a short position because the base currency is the CAD. And so you want to short that base currency, which is why we went short on that pair. Look, Euro Yen, I think, has been perhaps the best trade of the week you could possibly have traded. I actually just got off the phone with a trader a few hours ago who, before they knew about the COT report, they were shorting the Euro Yen all week just because that's what they thought. They thought it was going to go down. They just thought it was because they thought it was too high. And that's what's so cool about the COT report, is a lot of times it can keep you, if you're not going to use it, at least it could keep you out of some really bad trades. I think you should use it just because it can produce a profit, obviously. So anyway, really cool. Euro Yen, obviously another really good combination. So all of these are combinations of these highlighted currencies over here. That's all this is. And then the top 6 is what you're going to trade all week. So what I do is I just basically take the top 6 trades and I just hold them all week, right? Your 6, and then just and then you're going to plug in a stop loss. Typically that's just going to be a that's going to be a half, not a half, a full daily range stop loss, which we go get that from Maytaf, which is another thing we can talk about another time if you're new to the program. And then you just plug in your trailing stop, which, by the way, for those of you that are struggling with trailing stops, we did a basic training webinar on, let's see, in fact, let's go take a look at this. So we did a basic training webinar. Let me log in again. Actually, maybe, am I logged in right here? Yeah, I am. We did a basic training webinar on Monday. Let me pull it up here just a second. Yeah, if you look at Monday, we did a basic training, the weekly training. We did a full, if you haven't seen it yet and you need help with trailing stops, on how to set them up either on MT4 or how to set them up on TradingView, this would be a good class to go back and watch. Okay, so definitely go check that out if you are new or need some extra help with the trailing stops. So okay, so here's what I want to do now. So I've kind of explained the strategy in a nutshell. If you do have questions, let me know, and you can put those questions in the chat box as we go along. But I would like to give some time to Ben. To what he's going to do is he's going to pull up his journal, and we're going to comment on it. He's going to spend some time explaining what he did in his research. I even have some questions for him that I was going to ask. If you guys have questions for him, a cousin of mine, he's also a client and a member of our program. He's been trading since about, I think, October. And in fact, let me go ahead and unmic him real quick. So let me know if that doesn't work, Ben, in the chat box, but I'm going to go ahead and unmic you and get you ready. But he's been, and actually, let me make you a host as well while I'm at it. Okay.
Equitable knows the questions educators have about saving for retirement, like how do I start? How do I find the extra money? How do I make it last? Ready to confidently prepare for your financial future? Let's plan how.
And then let's see, does that let me?
Ready.
Okay, cool. Yep, awesome. So yeah, like I said, Ben's been with us since I think October. Is that right, Ben?
Yeah, about
Cool.
October.
Cool. Yeah, you kind of started off trading supply demand concepts, kind of got your feet wet with that, but you didn't have any experience trading before, right?
Barely
Yeah.
anything. Before probably September, I literally had no experience. So
Cool, cool. But I remember you talking to me. You were looking into a lot, just like basic financial education videos, investing videos, and you saw some of the things that we were doing, and you got interested in it. And it's been kind of a just you've been everywhere, right? I remember your journey. You've been telling your journey. You've been looking at different stuff, and you've been trying out different things. So what kind of drew you to the COT report specifically, and kind of the trainings that we're doing?
yeah, so I guess really kind of just mentioning what Steve was saying. I I just wanted I think every trader has to have their own journey, has to go through their own journey, learning a lot of things and failing a lot. I think we were talking about the other day, a trader needs to fail a lot to learn a lot and to become a better trader. If you can't learn how to fail a lot, then you probably if you might not be ready to do a challenge. You might not be ready to use real money if you're not willing to lose. Even a couple weeks in a row. And so I was doing supply and demand. I was doing price action. I was trying Fibonacci. I was trying everything possible, and none of it was really working long term. Really, my goal for trading was to make it more of a passive thing and not make it beyond me being on the charts 8 hours a day. That was something that I never really wanted. I've always kind of seen finance as more of a long-term thing, and I wanted to keep everything long-term and more of like a passive thing instead of active. And so when I started looking back at the COT report after in October, it's kind of funny how you have to go full circle sometimes to finally realize that you were being dumb during that whole full circle, but it's okay. I think everyone has to deal with that sometimes. But I finally came back full circle and I was like, wait, this just makes sense. And so I did a lot of research and I just went super deep into it. And I'm actually now, it's funny how you mentioned that I went back into May. I'm actually now wanting to go back into 2020 to see how even more long term. Granted, I'm not going to do that overnight. It's going to take me a while because I don't know if you guys have all done back testing, but because it's not fun. It's not a fun thing to do. It's not like something you do when you have free time or anything. So,
Right.
but that is what I'm anticipating to do with the COT report.
That's awesome. No, that's awesome. I appreciate you coming on. Yeah, I feel like back testing, the COT report is one of the more difficult back testings because it's you'd have to manually input all of that information, and I feel like it'd almost be faster to figure out how to program, like pulling that data out with a program or a system like that, which I have yet to figure out how to do. So, but that's awesome. Great endeavor. So tell us a little bit about your findings. So you did a back test into the summer of last year. So we're in summer of 2023, and interesting things about the summer of last year. I was just hoping you could make a few observations about, and you and I did talk about this just the other day. And I was hoping that you could make just a few observations of what you found.
Yeah. Just want to make sure, can you see, is it the COT report that everyone sees right now? I have multiple screens, so I just want to make sure.
I can see your screen. Yes. Can everybody else see it? Just give us that. Okay. Looks like we're good, Ben. Yep.
Okay,
Cool.
So as Steve has kind of already shown, we went all the way back until I think, what did you like? The first week of October, I think was the furthest. You might have gone into September a little bit.
That's correct. Yep.
You kind of got into this area right here. And I saw this right here and I was like, okay, this is really interesting. I want to see, I'm a numbers guy. I'm not an emotional thinker. I'm a logical thinker. I use my brain more than my heart, definitely. And so I wanted to say, okay, well, if I risked 1%, what could I anticipate to make on a weekly basis on average in the long term? And so as you can see right here, you see a 1% risk and then a 0.75%. So this is just if you're risking 1% per trade and if you're risking 0.75% per trade. So I calculated it all the way up to October 4th, I think originally. And I saw it was, I think the 1% risk was like 1.5 something, a little bit over 1.5. And then if you're risking 0.75%, it was a little bit, I think it was like 1.15, 1.2%, a little bit higher. And so I was like, okay, well, knowing myself, I wanted to go deeper into it. And so what I did was I just started back testing, and I kept going and I kept going and I kept going and going all the way until May 3rd of 2022. The rest of this right here is something I want to do in the future, but right now, not yet. I'm not feeling it yet.
You need to get a rest in between, right?
Exactly. And
That's
so I just wanted to let you guys know these are the only accurate numbers right now. The net profit, gross loss. These right here, don't worry about these. This is also includes all the way back into 2020. I have this function that shows how many weeks it counts on the A column side. So don't worry, it's not only 119 pips a week and it's not 38% win rate. I just want full disclaimer. It's really around 50%, and the pips I forgot, but it's definitely higher than 119. So I think I've only back tested like 35 weeks. And so just, take this with a grain of salt. It doesn't mean it. And so what I did was I kind of was just looking at how it went throughout each season of the year, kind of seeing how things were going. And of course, through Steve's back testing, you saw that December was frankly a pretty crappy month. And a lot of traders, as I think some of you guys know, a lot of traders avoid December just because the markets are a little weird. Everyone's just trying to close out everything before Christmas and New Year's and everything so they can just have fun with their families. And so the markets really are all out of whack. And so if you see here, you had negative, 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 negative. So you would have had a pretty bad December before you go into the holidays. So I was like, okay, well, is there any other times of the year that might be something that I can prepare for mentally? Granted, there are anomalies out there. There are just some months that you just happen to have bad months and you have no control over that. But I wanted to see if there was anything else that might help me. And I started seeing that everything was actually going pretty well. September was fine. You had some killer months, right? You had a killer week right here, 7% if you were risking 1%, or 5.25 if you're only risking 0.75%, which is an amazing risk to reward ratio. And then you kind of start hitting the summer down here. Let's see, in July and June were kind of off months. And I'm saying that not in a horrible way, because it really wasn't that bad. Like you see, you're barely losing anything here. You're barely losing anything here. Even here, they're not bad months, but you're not winning a lot.
just slow weeks, right?
They're just very slow weeks. For some reason, again, I'm just mentioning it could just be an anomaly, which is why I want to go into 2021 summer and see if the summer of 2021 was also bad. Because then maybe you could have some validity there saying, okay, summers anticipate that it might be a little slow, but it usually picks back up in August or September, right? And so I think I remember we calculated it the other day, Stephen. I think it was, you would have lost a little bit over the summer, but really not that much. But we were also mentioning that, look right here in May 31st, you would have had one of the best weeks ever right here. You would have almost made 10%.
In 1 week.
In 1 week, that would have been phase one already done. And then if you only risk 0.75%, which is what I'm currently doing right now, just because I want to make this more of a long-term thing, and I don't want to lose any account. I don't want to lose any of my funded accounts, anything. So I'm risking little to nothing so I can maintain those accounts in the long term. And even with that, you're still making 7%, which is an amazing week.
Yeah.
And so what we were kind of discussing the other day, and I think you guys can see it too, the summer might have been bad a little bit. Let's say, the summer was subpar. The summer wouldn't have been as good as you hoped. But if you missed out on this 1 week right here, you'd be really kicking yourself. At least I would be kicking myself.
Yeah.
If you just traded this week, right here, and then you would have had a crappier month, you still would have come out the whole crappy summer, if you want to call it, you would have come out very profitable. I think we came out at like 5%, 6% or something like that, which is amazing.
Right.
That's still
Yeah.
really fun.
Oh yeah, I think we cherry picked. If you were to have started the COT report on June 7th of last year and traded until I think it was like mid-August, you would
Yeah.
have been sorely disappointed. Like you would have been down, 5 or 10% or something like that. But had you picked up the May month, had you taken all the trades in May and then traded to August, you would have made about 10% total. So it's quite the difference, right?
Because look at all these great weeks right here. Granted, you have
Yeah.
negative one right here, but then you had almost four, and almost 10. So what this really shows, at least up to this point, we have, over a year's worth of back testing. It shows in the long term, as you see right here. And these numbers, you guys can all test. I think I told Steve to correct me if I did these wrong, but it's really just, I just did the Excel formula, just, the whole column. And this is what it shows right here. So if you're only risking 0.75% a week, you're going to average 1.1% a week, and then almost 1.5%. So let's say you have $100,000 trading account or whatever. You're going to risk, $1,000 per trade, and you're going to come out each week almost, 1.5K a week. Granted, you can't assume that's going to be every single week, of course, but averaging out, if you should think about this as more of a business than just like a little side gig to make me money real quick. If you see this more as a business, that's a very good business to be in. That's profitable.
Yeah.
And as you see here, it is a profitable business to be in. As long as you keep your head on straight and you're not doing something stupid, as long as you're using, a risk calculator. This is just an example. As long as you're calculating it correctly, making sure what I do before I put in the trades every single week, I recalculate. I press the calculate button like multiple times just to make sure that it really is 0.38 lots. I'm not going to screw myself over just over a stupid position size calculator. I'm going to screw myself over by doing something stupid, something else stupid.
Right.
So I would say just really make sure that you guys have your head on straight. Granted, I don't know if I have too much authority talking, because granted, I have only been doing this since October, but I can tell you that I have learned a lot, and I've probably failed more these last 10 months being a conservative trader, not being stupid, like risking 5%, but just being a conservative trader, trying to learn things. I've still failed so many times. And I think really you just have to just trust the process. And this is really this is probably the only strategy, at least I've seen and learned about. This is the only strategy that has actually proven to be viable long term, and it goes along with my vision of trading. I just go in Sunday night, I put in my trades, I make sure my position calculator is ready, double, triple, quadruple calculate just to make sure everything is good, and then I just let it go. Granted already, and that's totally fine. If that's according to your trading plan, that's fine. I think everyone should have a trading plan and a strategy. For some people, if you're not comfortable keeping all your trades open for that long, like after this amazing week, I bet Steve would agree with me, take half your profits or a quarter of your profits, just take some of it out just to make sure that, just to maybe help yourself a little bit and be like, hey, like, I'm protecting my capital first, and then I'm making money second.
Right.
If you really feel like you need to take a little bit because you've noticed in the past that things go up a lot and then it kind of comes down, just help yourself out a little bit and take a little bit of the profits. You don't have to take all of it out. I usually don't, but that's my trading plan.
Yeah.
You guys can do what you want. It's your business, your life, your trading rules. That's something that Steve and I or anyone else can't force you to do. Of course, Steve can say, hey, use a lot size calculator. I think that's something that you really should use, but I think anything else, most of the things that you should use with the call report in regards to profits and when you take your profits, when you check your stop, where your trades are, where you want to trade your stop loss, that's, you know, if you want to do the full trading stop loss, do half of the trading stop loss, whatever you want to do, that's up to you.
You know, that's awesome. Yeah, and I really liked one thing that you said in particular is following the plan and holding these trades out to fruition. Like you were saying, you know, if you close those trades early, still it was a good week, but you know, look at all the profits you would have missed out on, right? And sometimes you need some of those profits to kind of stay with the efficacy behind the strategy. In fact, something that you and I commented about the other day is something we learned in our finance classes. I remember my professor one time said, if you were to just remove the top 5 trading days of the year in the stock market, it would totally spoil the whole idea of investing in the stock market. So basically, if you have a 401k and if you removed the top 5 days of gains in your portfolio, it wouldn't be worth investing in the stock market anymore. And we don't know what days those are going to be. It's the same thing with the COT report, right? We don't know what week is going to be just absolutely ballpark phenomenal. We just have to continue to we have to keep throwing our darts into the system and say, okay, let's try it this week, and we just keep going until obviously we hit a big week and that kind of smooths out the average. So that's awesome. Ben, real quickly, Wesley asked a question here. He says, do you use a trailing stop while back? So when you did this back testing, did you use a trailing stop?
I did. That was actually probably one of the more boring parts. I had to use, like, you know, the ruler. Let me try to share my screen for the trading view, just to kind of show what I was having to do.
Hours of love from you. All the right parts from us. With eBay Guaranteed Fit.
This part wasn't super fun. Well, I don't know if back testing is fun anyway, but for some people love, I know a couple of people who love doing it, and, you know, good for them. If you can do it for me, I love that. But so let's just use, I guess I have the Aussie Kiwi on here. We are not trading that this week, but let's say, for example, you had a trailing stop loss, and yes, I do use a trailing stop loss. I guess let's say that first. And what I did do was, let's say you put in like at 5 o'clock on Sunday right here. Let's say like right at the close of the candle right here. What I would do was, let's say you had a 60 pip trailing stop loss on the Aussie Kiwi. So what I did was I calculated how much that, and I went to the wick. I tried to figure out what was the highest that price got at one point. So it was 46.4. So what I do is I would go into a calculator. I would usually just do it on my phone because I would be able to use it on there. What I would do is I would put 46.4 in, and I'd subtract it by 55, because I think that was what I was saying, right? So that's what because as you can tell here, the movement here, it went just down, right? It was going to go down anyway, and you were going to lose out on your money. So what I did was, if you had a 55 pip stop loss and it got up to 46.4 pips, I put in the COT report, I lost 8.6 pips during this trade. And I did that for every single pair that I had on the back testing. And so, you know, of course, if I was actually shorting this pair, then I would have, you know, I would have gone here. I would have started right. Well, I would have totally lost all my money. Actually, no, never mind. It would have come back. So, you know, I would have almost stopped out, but I would have came all the way back. And so what I would do was I would go here. I'd find out how far it went down. So it went down to 70 pips on the dot, and it finally comes back to break even. So I am assuming that, you know, you've already hit your trailing stop, right? So you just do 70 minus 55, and so you would have had a 15 pip profit, probably somewhere around here. So that's what I did for the back testing.
Man, that must have taken you a long time. So,
Yeah, it took
wow.
more than 30 minutes.
Oh yeah, I think you said you a total of 2 weeks you said you spent back testing each one. Is that
Yeah.
right? Wow.
Yeah.
Um,
Granted, I
it-
wasn't doing it 8 hours a day, so I don't want you guys to think I
right.
was doing this for 8 hours. I was probably doing it in 30-minute increments 4 times a day.
Yeah.
So,
Wow.
but yeah.
Let's answer a few more questions here. I missed Sandy's first question says a long time ago I heard that some pairs are seasonal. Is there any correlation to the pairs traded during the summer? I'll answer this one, Ben. So basically, yes, seasonality is a thing, Sandy. In fact, I used to subscribe to a service. I think it's just called seasonalforex.com or something like that. And basically, they built these charts that would show how the Aussie performed throughout the year. When did the Aussie have the highest up times, or when did the pound have its lowest lows, and so on throughout the year. So seasonality is a thing. However, these banks and these leveraged funds, they do take into effect that those things for us. They already do that work for us. So we're just responding to what leveraged funds already does. And then lastly, I was going to say, um, some years, not every pair is going to be seasonal either. It just kind of depends. I think fundamentals would matter more than seasonality. But yes, if there's not a lot of stuff going on in the economic climate, then yes, expect seasonality to take precedence over any macroeconomic variables. But yeah, great question. Roger says my plan is in writing. Excellent. Everybody should do that. Fantastic work, Roger. Um, and then maybe Ben, you could answer this question. Sandy says, did you also note the average loss?
No, that is a very good question. Maybe I should do that.
Okay.
Yeah, I could put another column in here.
Yeah, I think that would be good to know. I think why Sandy's asking that is just because we'd like to know, and this is something I could do with even my own statistics. I'm sure we could figure this out. Maybe I'll work on it on my own journal. Is basically, if I were doing a prop firm challenge, I would want to know, okay, how big is this loss actually going to get? I mean, obviously, if we're using a lot size calculator, there's a maximum amount you could lose in a week, right? If you're risking 1% often, or how much am I going to lose 6%? Like if you have multiple weeks where you lose, how big is that loss going to get? Last question, Ben, and I wanted to, and if you have anything else to share, that'd be great. But I wanted to ask you, so what is your opinion on like what type of prop firm challenge? You shared with me, you indicated that you're doing a prop firm challenge right now. What type of challenge do you think somebody, a trader, should subscribe to pass in the most conservative way possible? And then I guess lastly, second question with that is, what are you doing? What's the type of prop firm challenge you're doing that you feel like is most aligned with how the COT report performs?
So I guess to answer your first question, currently right now I am doing a prop firm challenge, and I am doing it with Funded Trading Plus. And that's not because Steve said it. I've actually been wanting to do Funded Trading Plus for a while. I am a more conservative trader, in the fact that I kind of ingrained itself in myself in my brain that I need to protect my capital first and then make money. And so currently right now I'm not risking 1% on each trade, just because I'm doing this. This is for the long haul. I want to make sure I do this for years and years and years. And I'd like to accumulate multiple accounts and never have to worry about losing any of them because of a big horrible week in the COT report. And so I'm only risking 0.75%. And I think it was Sandy who was saying that what the average loss is. I'm actually really interested now because I'd like to see what my average loss would be risking 0.75% to know, on top of a winning week, what can I expect to lose on an average week?
Yeah.
Because that would be very nice to know. If I have a really bad week, I would say, okay, well, this is an average week, it's fine. Or this was actually not that bad. I might have another week like this next week if just according to the average loss. And so what I am doing is, like I said, I'm doing 0.75%. It's probably going to take me a minute as the my COT report says, I'm going to make about 1.1% a week unless we have just an amazing month. Then I might, because, this week has been great. So sure, I'm up quite a bit already, but I'm not getting, and I think this is another part that I've heard Steve talk about many times. Like you can't get too, and I'm going to say this in the nicest way possible, I guess. You can't get too excited when you have a lot of money in your account, because that money can be gone. You have to separate yourself from the numbers. And granted, I've only been doing this for a little under a year, but I've accustomed myself to looking at it as just numbers, and I don't freak out when I'm up $3,000, or I don't freak out when I'm under, let's say I'm negative 4,000 or 2,000. I don't freak out anymore because I see it as, it's okay. This has happened. I've actually had worse. So this is actually not that bad. Negative 1,000 is actually great compared to negative 8,000 or something. So you really just have to separate yourself from the numbers. And so that's what I'm doing is, this week has been a great week, but I'm seeing this as an above average week. So I'm, it's going to be a very, hopefully, things go well the rest of this week. I may be able to close everything out Friday morning with a smile on my face, but then I'm going to forget about it as soon as I can, so I can get ready for next week. Cause every week is different. As you saw in the COT report that I started, you don't have 6-7 straight weeks in a row that you win, but you also don't have 7 straight weeks in a row that you lose, at least up to this point that I found. So you kind of have to just roll with the punches and just trust in the process and know that everything's going to be fine in the long term.
That's awesome. I appreciate it, Ben. And that's very wise advice. And I'm sure I'm speaking for everybody else here that we really appreciate the work that you put in and being willing to share on the spot there, the work that you did. And again, wow, just great work. That must have taken a long time. Thanks, Ben. I think I'll go ahead and take over again. But yeah, good luck with your challenge. I'm sure you'll do fantastic. And it sounds like you've got a real plan put in place. So that's exactly what we want everybody to do. And it sounds like you're on the way there. Also fun to talk to another subscriber in the program. So appreciate you, Ben. Awesome. Okay, cool. Let me go ahead and share my screen again. Cool. And let me see if there's any other questions that I have missed here. Okay, cool. Oh yeah, Roger. So FTP, so Funded Trading Plus, they have a 3% daily drawdown on they have 3 different programs. They have instant funding, they have a 2-phase challenge, and then I think you're talking about the 3% daily drawdown. That's for their program that's single phase. So you'll find with a lot of single phase challenges a lot of single phase challenges, they give you that really tight drawdown, max drawdown. With their 2-phase challenge, they actually give you a 5% daily drawdown. And it's, you still have to make the 10% return, but they give you unlimited time to do it. So you have unlimited time, max 5% daily drawdown, 10% total drawdown. And that's for phase 1 and phase 2. Phase 2 is still unlimited time, and you still get to keep that 5% max daily drawdown. The only thing you can't do that I think is unique, or a little bit more unique to Funded Trading Plus, is you can't hold over the weekend, which is fine because we close our trades on Friday before lunch anyway, or around lunch anyway, so should be fine. They allow news trading, which is new to them. No. They've always allowed news trading. That's a different one. So they've always allowed news trading. So I actually think, and it's just my opinion, and I don't want to, here, let me jump over here. I don't want to necessarily recommend a prop firm, but I personally feel like the COT report, if you're willing to do a kind of maybe if you're willing to not necessarily pass in a month, like a lot of these prop forms kind of conform you to pass in a single month, I think maybe Funded Trading Plus might be a better prop firm if you're willing to just kind of do what Ben was doing, like risk a 0.5% or 0.75% per trade, so the risk is a lot less. You know, maybe instead of having those weeks like this week where you make 7% in a week, I would postulate, Ben, you can tell us in the chat box if I'm wrong, but I bet you Ben's probably up like 4 or 5%. So not as much as everybody else who's up, you know, 7, 8% on the week. But I think the idea with Ben is to be slow and steady with Funded Trading Plus, but you're almost guaranteed to pass if you do it that way. You're not going to fail the challenge if you keep the risk pretty low like that. Yeah. Okay. So yeah, he's up 4 or 5%, which is great, but it's not like he's risking 1% per trade. So he wouldn't pass if it were FTMO where they're requiring you to make that 10% in a month. You know, if Ben has a good month, he might make, you know, 5%, 6%. And then, you know, if it takes him 60 days or 90 days to pass, then so be it. He's just kind of going the slow and steady route. And sometimes I think that might be the best way to go for a lot of traders. Plus, it will help you develop a lot of discipline and patience with the strategy if you're willing to be kind of slow and steady. So, all right, guys. Well, let's see. Any other questions about what we talked about today? I think today was very refreshing. It was super awesome to have Ben on and be able to talk about the strategy. And I don't have any plans with my trades. Obviously, the trading plan is to hold until Friday. So even though there might be a few news events coming out, there's really no reason to close. We did find during FOMC today. Obviously, FOMC kept rates the same as expected, and that really didn't affect us because we didn't even have any dollar pairs to begin with. So I'm just kind of holding, and we'll let our trades go until obviously tomorrow and Friday. And then we'll just look for some more trade setups in the morning if we can find some more. So, all right, guys. Well, I appreciate your attention today, and I appreciate you guys. Have a fantastic evening, and we'll see you guys in the next webinar.
Zaxby's new Philly, the garlic aioli grilled
Trade futures on the go with NinjaTrader Mobile. Place trades with simple order management tools. Access.
Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there just to let me know that it is indeed working. Hope everybody's having a fantastic
positions have been recently. All right. I find that there is just a lot of advantages for doing things manually. I've learned that myself just by doing the analysis on the charts, looking at the raw data, looking at the raw candlesticks, and manually drawing supply and demand and my trend lines. You know, I've also received many questions in regards to, you know, what kind of automatic, what do you call those things, indicators, or I forget the name, but you load all these different indicators and stuff on your charts, and then they automatically draw the support and resistance and supply, demand, and all that stuff. Yes, I've seen that. I've seen indicators that automatically draws zones and stuff, and you know what? They're all wrong. I'm sorry to say, but they're all wrong. I've looked at them before, and they are disastrous. Okay, so in my mind, the minute you hand over your power to something so that it can make decisions for you or do the work for you, you're automatically losing control of something that you should remain in control of. That's my personal opinion. And I know you're thinking to yourself, yeah, but what's the big deal about grabbing some data and tossing it inside of a spreadsheet? You know, if you have a spreadsheet, what's the big deal of those cells being automatically filled in with numbers? Well, if it's no big deal for you, then do it. All I will say is, if you have it automatically filled in, you will never know what I know about doing it manually. That's it. I can't convince you. If you're sold on doing it the way you want to do it, then you're going to do it the way you're going to do it. I can't change your mind about that. But what I can tell you is that I reap the benefits of doing it manually, and I can't really put into words what those benefits are. All right? I have a routine every single weekend. Friday comes, sometimes I do it Saturday depending on what's going on in my life. But usually on Friday, the data will come out. I'll make myself a tea or I'll make myself a coffee. I come down to my desk. I sit down. I go to this website here. Okay? Same thing. Every weekend. I scroll down to this section here. Current legacy reports. Okay? And right here, Chicago Mercantile Exchange. That's the one that I want. And then I click on here, short format. And that takes me to all the currency pairs, the major ones, okay, the main currency pairs. And I click on that, and the data comes up. And I like to just shorten my window like this. I have this on one screen, and I have my spreadsheet on the other one, and I like to run through. I always scroll down, and then after Russian is Canadian. There's Russian ruble right here, and then the Canadian dollar. All right. So the first thing I do is I look at what is here, Canadian dollar, and I look at these columns here, long, short. Okay, there's non-commercial, commercial, Canadian dollar. There's long, there's the short, and then there's the long of commercial and the short of commercial. All right, so this is where I begin. And I take this data on here and I copy it. So I take my tool and I copy these cells like this, and I make a replica of that down below. and I change the date to reflect the date of the data, and then I start filling in my information on these cells. So this gives me a brief overlook of the positions and how they changed. I like this page here on my spreadsheet because it gives me a brief overlook. Okay, I get to see it, you know, and I get to see what the changes were, right? So the US dollar, longs 27,000, shorts 24,000, and that's non-commercial. That's the hedge funds, banks, institutions that are betting on making money buying when it goes up and selling when it goes down, right? And the commercials, the corporations that are hedging, they're usually going against what they think the value is going to do. If they think the US dollar is going to go down, they want to be more long. If they think it's going to go up, they're going to be more short. So they're always going and doing the opposite of what they think the how the dollar is going to go, or whatever asset they're investing in. And you know what? I get a lot of people coming up to me saying, well, that's not what I was told. I was told that the commercials are the big players. They are the ones that with the major money, so you want to do what they do. Well, yeah, you would be told that, wouldn't you? All right? Just like we were discussing how the media lures people into taking the exact opposite of the trades that the banks are taking. Well, when it comes to the CFTC data, what do you think would be the advice? To follow the non-commercial, the ones that are actually speculating on the markets? Whether it goes up, they want to buy. If it goes down, they want to short. Would you not want to be following those guys? Why would you be following the commercial? When you investigate what the commercial are doing, they are just hedging against real positions that they carry. So it only would make sense to be focusing on the non-commercial. So again, that is another myth, that you should follow the commercials. You should not follow the commercials. You follow the commercials, you get yourself in trouble. You'll be doing the exact opposite of what you should be doing. All right, so when I plug the data in here, when I come here and I look at the data, the first thing I'm doing is I'm looking at longs. And then I'm looking at my data, because when I copy and paste this portion of my Excel spreadsheet, I get to see the data from the previous week inside these cells. Okay. And so the other question I always get is, why did you switch long and short positions? Well, because these are futures contracts. Okay. So when you look at a futures contract, the chart, if the Canadian dollar is getting stronger, price is going up the chart. Okay. But if you look on a US CAD chart, if the Canadian dollar is getting stronger, price is dropping on the chart. Why? Because it's the US dollar slash Canadian dollar. Whatever currency comes before, that's the main currency. So if price is dropping, that means that currency at the beginning is getting weaker and the other one's getting stronger. Unlike the futures contract, if you look at a chart of just the Canadian dollar futures contract, if it's getting stronger in price, it rallies up. Okay, so I know that if the institutions are adding to their long positions, when it comes to the US CAD, they're adding to their short positions. Okay, because the US CAD will drop as the Canadian dollar gets stronger. That's why I switch, and I only switch them for the CAD, the Swiss, and the yen. Why? Well, because those are the only ones that have the US dollar in front of it. US CAD, US Swiss, US Japanese yen. All the other ones have the other currencies in front. Aussie US, Euro US, Pound US, Kiwi US dollar. All right? So that's why I switched them. Because I don't trade futures contracts, I trade currency pairs. If I traded futures contracts, I wouldn't switch them. But because I trade currency pairs, I do. All right. So, so going back to the data, so I come here and I grab the data, 82,000, and I automatically plug it into this field here. And as I'm plugging it into that field, I'm looking at what it was before. Okay, what was the number before? And I'm automatically thinking about what I've been pondering all week. If I'm looking at price action doing this on the charts, what is the story of price? What is taking place? What's the banks doing? Why are they doing it? So I'm building up these questions in my mind all throughout the week, because I'm constantly looking at the charts and I'm trying to put the pieces of the puzzle together of what the banks are doing with price. Are they about to take profits on those major short positions that they've been accumulating? We're getting pretty close to supply. What do I typically see during this phase of the market? Are they typically closing positions, closing short positions? So what would I want to see in the data next time the data is released? So I'm building up this suspense, okay? I'm building up the suspense throughout the week. When the data comes, I can't wait to see the data. I can't wait to compare the data with the previous week's data, so I can see what my suspicions were, if they were correct or if they weren't. Or if I have no idea what to expect, I can't wait to see what the data is so that I can start building a picture in my mind and putting the pieces of the evidence together to create an idea of what is taking place. So I like this this overview here because, like I mentioned, I plug in the figures here and it automatically tells me what the net positions are. Okay? So if we've got, let's say, long positions 27,000 for the US dollar, short positions, so if you're long 27 and short 24, then your net positions are 2,600. Okay? Just like US CAD, if you're long 35 but then you're short 82, the difference is 46 minus 46,000. Okay? And then I look at commercials as well, right? Longs and shorts, and then that gives me net positions. So yes, it is important to take into consideration the commercials, because the commercials are investing big money in the markets. Yes. But I would not pay attention to their actual positions. If they're very bullish, the US CAD, which you can see they are, net positions 74,000, okay? If they're very bullish, if you know that they're only opening up positions to hedge against real assets that they have, then the more bullish they are, they're really bearish, okay? They're really bearish. So for me, I want to take that number that is bullish and I want to make it useful for me as if it was a bearish number. Okay? So what I do is I do a calculation to calculate this minus 46,000, and I add this as a negative number to that minus 46,000, which gives me a total of negative 121,000. So now I know overall between the non-commercial and the commercial just how bearish they are. Okay? So that tells me a lot right there. That tells me a lot, just how bearish they are, taking into consideration the commercial and non-commercial positions. So that is how I incorporate the figures from the commercials. This is how I use their information. I don't take their bullishness and make it make me believe that price is going to become bullish. Okay? It doesn't influence me to believe it that way or to look at it that way. I look at it as a very bearish number. I just put a minus in front of it. So the difference of the previous week is, what was that difference in number the previous week? It was negative 104,000. So what's the change from last week to this week? They added negative 16,000. So over the week, I know just by a quick glance of this that they have gone more negative, okay, more bearish with their position. So that's why I like this overview, because really quickly I can just glance and see exactly what just took place over the last week. Okay, so once I get that done, what I do is, if you look at the bottom here, I have tabs for the US. All of them: gold, silver, copper, oil, nat gas, oil, heating oil, and propane. So what I do now is in each of these tabs, I have all the data that I collect, and I copy and paste from this main chart here. I copy and paste all of the data into these columns. Okay? And the data, as you can see, I can scroll back, it goes and goes and goes and goes. All right? I have all the historical data from day one, since they started collecting data. I have it all. All right? But not all of the information is relative to what we are doing now. And so I'll give you an example of why it's not. So, for instance, if you look back when they started collecting the data, let's just take a look here, for instance. Let's look at the euro, okay? We got the maximum right here. We got the maximum, the minimum, right? Here we go. Right here. So let me just bring that up. Okay, so max positions were 266. And that's for longs, okay? 266K. And for shorts, it was 271K. So if you go back when they started collecting positions, the data is not it's not anywhere close. The positions that they held is not anywhere close to what they are holding now. Okay? You look at them and they were like 10,000, 15,000, 20,000 long, 15, 20,000 short. It's nowhere close to where we are today. So the value in collecting the data is to know the difference between how they're holding positions now and how they were holding them yesterday and last week and last month and 2 months ago and 6 months ago and 1 year ago. That is the power of collecting the data, is being able to put it up against historical data and then comparing what they did in the past to what they're doing now. That is where the power is. So I don't want to compare this week's data with data from the 80s, because it's not going to be relatable. All right, they're two different things. So if you've got in the 80s data was down here, this stuff is not usable for me. But in the last year, you have data here, here, here in terms of size. Okay, so let's say this was 200K and here was 266. Okay, and all throughout here it goes up to 10, 220, and so forth. Okay, if you're looking at the data and you see that there's a buildup of data like that, what I'd like to do is I'd like to take a look at this data and see where it relates to the chart and get an idea of why they had that many positions when price was doing whatever it was doing on the charts. Okay, but I want to compare today's data with all this data. All right, it's almost like a moving average, right? Price is where it's at now, but if you look at, so we have price is doing this, right? And then you have a moving average. Okay, that's the green moving average. And price is here now, but based on the moving average that this is above average of where price is, right? Price is above average because the moving average is taking all of the data for the last week or 10 days or 20 days or whatever, all the prices, and then adding it together and then dividing it by that many days and giving you an average. So you can tell that where price is right now, it's above average because you can compare it to a moving average. So we do something very similar with that. Because again, we always want to compare what the positions are now to what it has been. So we're always doing that. And so let me bring you back to the spreadsheet. So here's the spreadsheet. And so here's data right here. And if you take a look here, 13 period average. That's my number, 13 period average, okay? Now some people ask me, why do you use a 13 period average? Why not a 14 or a 20 or... Well, because I've tested a bunch of them. For years I tested, when I came up with this idea of having an average number, I was realizing that, you know, when price, you know, let's say we have an institutional area of demand on the chart, okay? And let's say, you know, price is coming down and it contacts this institutional area of demand. What will happen is that as price is dropping, the banks are adding short positions majorly, right? But sometimes they'll start adding in long positions as well as price gets down here. Okay? And so this is a phenomenon that takes place all the time. And the reason why they're doing this is that they're preparing to shift momentum to the upside. And so if you take the average of all the positions throughout down here, okay, if we're looking at all the positions that were being held as price was making this move down, remember we want an average of all the shorts and an average of all the longs. And what you'll see is that, you know, let's say short positions right now are 250,000, okay? But the average is 230,000. So when we compare what the actual number is right now with what the average is, we can tell that right now short positions are above average. All right? You see how that works? So price is dropping really hard. Short positions are above average because the average is 230,000. But what will happen is that they'll start to close off those short positions, and they'll start to do it aggressively to the point that this 250,000 will eventually become 220,000. And by the time that takes place, this average will probably drop to, let's say, you know, just ballpark, or it will go up because it'll catch up to these high numbers down here. So let's say it's 240K. So then you would look at the real positions of shorts, and you'd see the banks are holding 220,000 short. But the average is 240, which is telling you that current positions are below average. So based on what was taking place all throughout this drop, based on this whole dynamic of this drop in price, the current positions held by the banks right now are below the average. So if I went to you and I said, hey, listen, do you want to go long or short the US CAD right now? If you were to say, well, I want to only do what the banks are doing. And if I just came to you and said, well, I'll tell you one thing, that they're holding long positions and they have 170,000 K long. And you'd say, okay, interesting. What about their short positions? Oh, their short positions, they hold 220,000 short. Now, automatically, if you didn't do any logical thinking about this, you would just say, oh, longs are 170, shorts are a lot higher, 220,000, so I think I want to be in short. Aha. But that is if you just didn't think about this on a deeper level. This is all you would extract from it. But you have to think about this on a deeper level. That's why I always mention that thinking logically and critically is essential to understanding the CFTC data. It's not just about looking at the numbers and saying, oh, well, if they're short 220,000 and they're only long 170,000, then of course I want to be short. But now if I add in this other piece of information and I say, well, before you make your trading decision, let me just tell you, the last 13 periods where the data came out, based on the average size of the last 13 periods, they would be 240,000 short. And they're only 220 right now. So they're below average, okay? Which is telling you that there's a shift in the momentum and the direction that these positions are going in. They are not building higher, they are reducing, all right? So if I now went up to you and said, hey, the US CAD, would you like to go short or would you like to go long the US CAD? Your question could be, well, I want to know two things. One, what are the positions held by the banks? And I said, well, they're holding 220,000 short. And you're like, okay, what are they doing with these positions right now? Oh, good question. They're actually getting, they're offloading these positions. What they've been doing up until today is recently they've been offloading those short positions. So they're giving those short positions to somebody else and taking profits on those short positions. Okay, now that tells me something different. What about their long positions? Oh, longs? Yeah, no problem. Longs, they used to be 150,000. But now they're 170,000. Oh, so they're accumulating long positions. Yes, they're accumulating long positions. Okay? Their average used to be 150,000, and now let's say the average is 170,000. So shorts, the average, we see that new positions are way below average, which means there is a shift in the dynamic of what they're doing with their positions. All right, they're no longer accumulating, they're offloading. So we really don't want to be getting into a short position when the banks are offloading a position, right? That wouldn't be a good idea. We want to time what we do with what the banks are doing, all right? If the average long was 150K, but then later on it became 170K, okay, and their actual long positions, let's say, was 185K, you'd say, hold on for a second, the average right now is 170, but their actual positions are 185,000? Yes, that's right. So based on the last 13 periods of data, the average is 170, and they're actually above that? Yes, that's correct. So what does that tell you? That means the momentum at which the banks are accumulating long positions is pretty aggressive. So much so that it's not sitting at the average size of positions. It's above average. So they're accumulating it at a fast pace. So even though short positions could be at 220K and long positions are at 185K, you wouldn't think, well, shorts are bigger than long, so I want to go in short. You wouldn't think that. You would have to analyze the data, put it into its context, extract the information from it, and come to the realization that they are shifting the momentum with their positions and what they're doing with their positions. Okay? So that is how you extract the information to determine what is likely going to take place. So that is what this 13 period average is over here. It gives me the 13 period average of the positions held by the banks. And if we take a look at the euro, look at the long positions, 232,000. Look what the average is, 206,000. Okay? You see how much higher 232 is from 206? Aggressive, right? But I'll point out something else to you. Look at the average size of short positions, 110. Look at the actual positions of short positions, 132. Do you not see aggressiveness on both sides? So both longs and shorts are aggressively accumulating. You see that? That's important information, because you see how we extracted, using the example of the US CAD, how we could determine that it would probably be a bad idea to be getting in short if they were shifting that momentum to offloading short positions, right? Well, when we look at this, what do we see? We see that they are aggressively accumulating both longs and shorts based on what their positions have been recently. So that's important information to recognize. We want to know that. All right, and that will play a role in how price it will eventually play out. Okay, so we keep our eyes on that. So so this is what we do. This is what I do every weekend. And when I plug that data in here, I just click up with my mouse here, and here's May 25th, ready for inserting new data. When this Friday comes and I got the new data, I'll be creating this main chart here, plugging in all the information, and then copying and pasting that information into my chart here. And as I'm plugging the information in, I am looking and comparing what price was previously and what it is now. Okay, and I'm picturing what price looks like on the chart and comparing what I see with the data, realizing what it is that they're doing, increasing or offloading or decreasing. And automatically my brain is thinking about what I know logically about what I'm seeing, what I've been able to piece together by examining the COT data for many years. And I try to put together a picture of what is likely taking place. So it's a whole process that I go through. And I like to do it manually. I can't even think about coming to my spreadsheet and then having the data already plugged in. I feel like I would be robbed of something, I feel like I'd be cheated of something. I feel like I would be cheated of that little extra moment where I get to click on that and look at the numbers and actually type in the numbers myself and actually compare it with my eyes as I look at the other cells. So so I like to do it manually, all right? So that, I think, is a very good introduction to the COT data and the importance of the COT data and how I extract the information, plug it into my spreadsheet, the calculation that it does, and why I like this 13-period average. And again, the 13-period average, people ask me, why 13 periods? I've used 20, I've used so many different ones. 14, 15, 16, 10, 7, 8. I've used the Fibonacci numbers, okay? I've used a lot. All right, so if you can just pause for 2 seconds and hit the like button for me, I'd appreciate it. Show me that you are enjoying the content that I'm sharing with you today. These are things that have taken me a long time to put together. Okay, it has taken me a long time to put this together, and I'm constantly building on my knowledge every single weekend when I put the data together. I'm constantly building, and it takes me a long time. It's a major commitment, because every weekend when I put together the Arujo report, I'm spending at least about 20 hours at least every weekend, where I go through the data, plug it in, I go to my charts, I compare the data to the charts, I look at historical charts, I look at the historical data, I look at past patterns, what they did, how they did it. I reanalyze my zones, I reanalyze my trend lines, and I put the picture together of what is likely taking place, and then I have to do it for the pound and the yen and the Kiwi and the US CAD and the Aussie and the US dollar, and then I compare the stories with each other. It's like an investigator goes to the crime scene, right? There's one crime that's been committed, meaning there's only one story that's really in play. And all the markets have to be in line with that story. That's just how it works, right? So it's looking at all the different stories, comparing all the stories together to see if they are relatable in any way. And if there is no relation, then there's a problem. Then that means something is not right. So then I have to go back into the storyline and figure out what part of the story, whose story is not in line with what's taking place in the overall markets. So that it takes up a lot of time. Even with the experience that I have, it still takes up a lot of time. And to be honest, I put in the extra time that is not even necessary sometimes because I love the process, because I love the information that I get to pull out of the markets by doing this. Okay, so it takes me a long time, and that's the eventual outcome is the Aruja report. All right, I could give you a quick look at that. I'll give you a view of our latest Aruja report that was completed, May 23rd report. So so after a careful analysis of the markets and the data, I do this report. Okay, I do a market summary where I go through the key things that we're watching for in the markets. They are the key storylines, right? That are taking place in the markets, and the key charts that I'm watching, and why I'm watching them, and what I'm watching for momentum to kick into the markets or for trades. All right. So like when it comes to gold, I'll put down here what I am seeing in the storyline of gold, what the data represents, why it represents it, and what we're waiting for. There's an overview, price consolidated on the weekly chart. The banks increased their longs again from 282 to 290,000. At the same time, they also increased shorts from 89,000 to 91,000. We saw the breakout take place this past week. This is what we were waiting for, and now ideally we want to see the uptrend. Sentiment is starting to turn bullish now. For there to be sustainable momentum, we would want to see at least a daily uptrend form from these lows without the monthly demand breaking. Okay, so we were expecting certain things to take place. Now, why do I put these things? Okay, why do I put these things? This is what we are waiting for. The reason being is because how do you know if your analysis is correct unless you put yourself out there and make forecasts and then see what eventually happens? So we are constantly doing that at the school. Okay, we are constantly putting out forecasts, even in circumstances in the markets when the markets are not highly predictable. We are always putting out forecasts. I personally am always putting out forecasts. Why? Because this is how we learn. I'm looking at the data and I'm trying to figure out what's the storyline. So if you know what the storyline is, then you would know what is going to be coming in the following week. It's like a movie, right? You're halfway through the movie, you've seen these type of movies before, and you're like, oh, watch what's going to happen. In the next scene, they're probably going to be, best friends again. They're going to get over this argument that they had, and they're going to be best friends again. And then the next scene is exactly how you thought. So the markets are the same way. I look at it the same way. I look at what's taking place, and I see all the data, I collect all the data, I do the analysis on the data, and then I make my forecast. Based on what I'm seeing, here's the storyline, this is how I'm seeing it, and it's likely going to do this next. And then the next report will be like, well, boom, isn't that what we were expecting, that breakout to the upside? Well, we did indeed get that, which means the interpretation of the data was correct. And so I do this every single week. And this is how we learn. Students that join, they read these reports, and this is how they build up their understanding and build up the logic of how to read the data. Okay, it's a whole process of understanding how the data reflects on the charts and how to forecast what price will do. All right, so that's what we do with the Aruja report. And yeah, so I'll leave it at that. That was a good session today on a good introduction to the Aruja report and the caught data. So if you have any questions, I'll run through the chat here. If you guys have a minute to hit the like button, I would appreciate that as well. And we'll go through your questions. Let's see. Oh, we got a lot of things, a lot of comments here. Indicators are for lazy people. Yeah. Hi, Kevin. Is there any value in tracking Euro, FX, British Pound? I haven't found any value in that. I haven't found any value in that. The cross pairs, following the cross pairs data. You don't need to. You don't need to because, and we'll talk about this in future sessions. You look at the main pairs and you look at their charts and you figure out their storylines. And so if you figure out their storylines, then you know what's likely going to happen on those charts. So if you know that the euro is very likely to be strong, and you know that the yen is very likely to not get either strong or weak in the weeks to come, then you know the euro yen is a good chart to trade long. Okay, so there's a power in just getting the information from the major pairs, looking at the charts, reading the storyline, and then all the cross pairs, you'll know which ones are good to trade based on just that information. We will have the Excel sheet so we can edit it weekly. No, I don't give away my Excel sheet. This is my baby that I've spent many years working on and creating. I don't just give out this spreadsheet. I encourage people to create their own spreadsheet. All right, and you know I've had students come up to me and they're like, why don't you just give us your spreadsheet? And it's like, well, when somebody gives you something, how much do you appreciate it? How much work do you put into it? How much value do you have with it? My spreadsheet is my world, all right? And because it's so valuable to me, I don't just give it away to anybody. I don't. So those same students, I say, listen, here's how you make it. I have video lessons on how to create it, how to code it and all that stuff and all the formulas. And all you have to do is start plugging in the data. When you become a Sherlock member at the school, and those are for those that are putting in the work and effort and really showing that they are interested in learning and excelling as a trader, I make them members of the Sherlock club. And once you're a member there, I have all the historical data there that you could just plug into your spreadsheets. But I don't just give that away to everybody. It doesn't work that way. In life, you have to work and you reap the benefits of it. You don't just join something, pay a few bucks, and then think you're going to get everything. It doesn't work. Life doesn't work that way. And it's in your best interests for it to not work that way. Those who actually said, okay, fine, I'll just do the work, I'll do the spreadsheet. Fine, you don't want to give it to me. They make the spreadsheet, they come back 6 months later and they're like, thank you so much for making me make the spreadsheet. I'm like, now do you understand? He goes, and they say, yes, now I understand. If you would have just given it to me, I wouldn't have realized the importance of the cells and how it works and why it works. I wouldn't make it my own. It would just be yours automatically doing calculations, and I wouldn't quite own it. It wouldn't be quite mine. It wouldn't, so I wouldn't really reap the full benefits of it because it wasn't going to be mine. And I'm like, exactly. But could I have explained that to you before? No, you wouldn't have gotten that, correct? And they say, yes, that's correct. Okay, well, now you know why I told you make your own. Because I didn't want to rob you of that experience. And so once you create your own and you start doing it and you put the time and effort into it, it becomes yours. You work hard through the school. I'll make you a member of the Sherlock Club, and then you have access to all the historical data. You plug in that historical data, and then you have your own sheet. Okay. Let's see. Collecting all of that data, that is dedication, but what you have to do. Yeah, that is dedication, but what you have. Collecting the data is dedication. Yeah, you have no idea. You have no idea how long I've spent collecting data, analyzing data. It's just the amount of my years I've traded to analyze charts, analyze the data, collecting the data. So I have all the historical data. So I've saved everyone a lot of time. All you got to do is put the time and effort and show me that you really want to learn. Show me that you're committed. Because when you first join, you don't need a spreadsheet with all the data. You don't need that, all right? You need to work on locating supply and demand zones and drawing your trend lines and doing analysis. That's what you need to work on. But if you're really committed to that and you're really putting in the time and effort, then yes, I'll make you a member, and then you'll have access to the data, and then eventually you can build your spreadsheets and you can do your own spreadsheets as well. I found, Kevin, through COT data, research stayed for the demand and supply teachings. It all makes sense. Yeah, combining supply and demand as we teach it with the trends, the trend world more powerful to determine what's going to take place in the markets than combining those two. Nothing comes even close to it. I would hit like every 5 minutes, but I can't. Oh well, priceless. Love it. Thank you. Thank you, sir. Yeah, if you haven't hit the like button yet, now's a good time to do so. I like the 13. It shows about 1/4 of the data. Yeah, 13 is also it's also quarterly, right? 13 weeks. It pretty much is 3 months, right? So it's quarterly. And so I think there might be something to that, where quarterly the banks have to reach certain criteria or certain deadlines or certain quotas. Something is up with that, because 13 is that number that just works so well. Trade price action. This really puts it all together. I will be checking out the White Oak membership. Oh, that's great, Blake. Yeah. I spent 1 hour pulling data and thought I was overdoing it. You spent 1 hour pulling data and you thought you were overdoing it. That's funny. When you learn supply and demand from Kevin, you will immediately throw support and resistance in the trash. Do you work on long-term only or any scalping? So, so remember, in the session that we did yesterday, we were talking about looking at the different time frames and being able to determine what time frame was a green go and what ones were red no. Okay, stop, don't look. And so collecting the data also allows you to determine what is likely going to take place. So if we had monthly chart in the red zone, weekly chart in the green zone, daily chart in the green zone, and 4-hour chart in the red zone, if we're looking at the data and examining what they are doing with their positions, and we come to determine that they are likely going to be closing off, that what they're doing is closing off a lot of their short positions on the US CAD, for instance, and they're starting to pile into their long positions, then we look at the charts and we realize, oh, wait a minute, daily chart's in the green, but the 4-hour isn't. So, but we can expect or anticipate that the 4-hour chart will eventually create an uptrend. Why? Because this is what they do when they're closing off major short positions after a major drop, and they're taking profits on short positions, and they start accumulating aggressively with their long positions. This is what they do. They create uptrends on 4-hour charts. So that is valuable information, especially when you are trying to anticipate the next moves. So price comes down to a 4-hour demand zone that should be used to facilitate a move higher to create a 4-hour uptrend. Well, guess what? You can take shorter term trades when price comes down into that 4-hour area of demand. So using the COT data, even though the data is, only released once a week, and it's to give us a bigger picture of what's taking place, this bigger picture can be narrowed down to very small time frames. It's all about reading the story of what's taking place with price to determine what is likely going to happen. Okay? So that is how we would use that. So yes, you could take shorter term trades by using the COT data. Okay, it's very possible. All right, and we do it from time to time. I don't focus on the shorter time frames because I'm just busy doing other things and looking at the higher time frame charts, and I'm involved in trades based on the higher time frame charts, and it's just too much work to be drilling down to 1 hour charts and 15-minute charts on all the pairs that I trade. It's too much. Do you work on long term only? Okay, so I answered that. Do you look at futures? No, not really. I look at gold, oil, not so much the indexes. Um, Juan Ramos, is your overall strategy more scalping or long-term trading? It's more, it's whatever I need to do, whatever wherever the opportunity is there. If there's a great trading opportunity that is a short-term trade, I'll take it. But my focus is mainly on shorter term trades, like holding trades for multiple days and swing trades. And at times I'll hold trades for a year or 2 years, depending on, if there's going to be a massive move. All right. When there's a massive move coming from very low on the chart, and I believe that it's going to rally up very strongly, then I'll start accumulating an overall position down at those lows. If I see the banks are getting out of their short positions and accumulating major long positions at major demand, low on the chart, I'm going to start accumulating a big long position from those lows. And if the targets are very high, based on the supply and demand dynamic, and I know that price is going to rally up very high, then I'm going to hold those positions for as long as I need to hold them. I'm not in any rush to get out of them, so I will hold them. Yeah, so it all depends. I trade whatever the opportunity is. The power of what it is that we do with supply and demand and reading the data is we can see what dynamic is in play on the charts. We can see if only shorter term moves are expected, if midterm moves are expected, or longer term moves are expected. We know when there's a major dynamic shift. If trends were trending downwards, if price was trending downwards and momentum was downwards, and it comes into contact with major demand, and we know that the trend is going to change to the upside when this major demand comes into play, then we change the type of trades that we're looking to trade. Those shorter term short trades, we throw out the window and we start focusing on shorter term long trades until momentum builds on the higher time frame charts, and then we start focusing on longer term long trades. So whatever is happening with the charts, we can quickly adapt and know exactly what is taking place as it's taking place, and we just change the type of trades that we look to engage in. It's pretty much that simple. Okay. Over the years, I'm sure you could spot order flow on the chart. Would you consider the COT report to be more reliable than seeing the order flow on the charts? I've never really studied order flow. I get the concept of it, but I look at the COT data and it basically tells me the order flow, right? I see it. I can compare it to what I see on the charts, and I see exactly what they're doing with their positions, where they're taking profits, where they're getting in. I see what's going on. And to know the difference between while they're adding longs only as a hedge, or while they're adding longs because they're preparing to push price up, being able to determine those little differences is you only get that with the experience of reading the reports and analyzing the charts and seeing the difference between the two situations. I have fine-tuned one of my sheets to reflect green and red zones to keep me sharp. Nice. What keeps you motivated when you feel bored? That's a good question. What keeps you motivated? Like motivated in what? In trading? I'm passionate about trading, so I've never lost motivation. I've always been motivated to do chart work, and if I'm not motivated to do chart work, I do something else. I go for a drive with my family. I go out to the park. I go and garden. I go for a walk. Do something different. Live life. You shouldn't be bored. If you're bored, grab a book and read. I think the key thing is you got to find balance in life. All right, you can't make everything about trading, because then you're just gonna eventually get to a point where you're just doing the same thing over and over again, and yeah, you are gonna get feelings of boredom. So find other things to do in life that entertain you. Trading is a business for me. It's a passion, but it's also a business. And every decision I make is based on, it has to be based on strong analysis. If it's not based on strong analysis, then I cannot take any trading decisions based on it. So my motivation is there because I just love to get things right. I love to know what the story of price is. I love to figure out the puzzle. It is my passion. Every time I figure out the puzzle and then I wait a week or two and then price plays out in my favor in the direction that I was anticipating it to move in, there's so much joy I get from that, so much satisfaction I get from that. It's the ultimate satisfaction, you know. Before, when I used to run my family business, so many times I would do so much work but not reap any benefits from it, not ever get rewarded, not ever get a pat on the back, not ever get complimented. And it was just you know, it was just not a good feeling to get. It was disheartening, okay? And with trading, I'm constantly getting a pat in the back, because if my work is done correctly, all I have to do is sit back, watch the markets, and then see price play out in the direction that I believed it was going to. And when I'm in a situation where the markets are good for trading and I'm in positions and I wait patiently because my analysis tells me I should, and price moves in my favor and my positions grow in size, that is also very rewarding. I get instant gratification from my work. So I'm constantly motivated to work. So that's how I look at it, okay? I don't get bored. I don't sit in front of the screens and say, I'm bored, I want to get into trades. Because I have 1,000 other things I could do that don't involve trading. That's studying charts, studying the data. I mean, I can go on forever just studying charts and studying the data and reading the story of price. It always comes down to that. The thing is that if you're doing different type of analysis that is not looking into the reality of what's happening in the chart, you can, what they call analysis paralysis. You can have analysis paralysis. Analysis paralysis is that you do so much analysis that you're getting so many conflicting results or so many conflicting conclusions. That's a problem. You shouldn't be having so many conflicting conclusions. If you're really studying the charts and extracting the real information, the longer you put into looking at the chart, the closer to the truth you should receive. That's how it should work. There is no analysis paralysis when you're doing real analysis, the true analysis as we like to call it. Looking at the charts and extracting the truth of what's taking place. You don't get analysis paralysis during that. You're actually getting closer to the truth. All right, we're going to have to wrap up soon. Hit the like button if you don't mind one more time. If you haven't, let's see. Read the rest of your questions. I have set my alarm to remind me to check on my wife. That's funny, Jason. Yeah, you get so busy with the charts, you got to set the alarm. Make sure to check with your wife. The more I learn, the more I'm motivated. Yeah, great. Yeah, exactly. Well, same thing. I feel the same way. The more I learn about the markets, the more I'm motivated to learn more about the markets. Okay, so do you use news reports? Never. Never. I just look at news just to see how they're suckering people into doing the exact opposite of what they should be doing. Okay, that's it. Great. Well, that was a good session. I think that was a good introduction to the CFTC data and the spreadsheets that I work on and how I use them. In future sessions, we'll go deeper into them and examine how we use the data to determine if price is going to reverse, if they're hedging their positions. There's so much. We can go on forever, okay, about the COT data. There's so much information. Just so much. Once you start to realize just how much information there is about the COT data, you're never going to look at the COT data the same way ever again. Okay? But that's it for me, and it's 10 o'clock, 1 hour we spent together.
It is everywhere. They own businesses that you have no idea they own.
There's this kind of narrative that private equity firms are corporate raiders.
What is private
issues that existed prior to COVID-19, but were just compounded. And the work that our team and the New York community has done for a national cohort with the Philly Fed has really been immeasurable and has led to a lot of the work that you're seeing today. Here we sit as we focus on some of the people-centered programs. We also focus on building place. And where we sit here today at the Yorktown Hotel, a $70-ish million economic development project in the York community to ensure that this building remained a complementary asset. But we weren't just focused on the bricks and mortar, we were focused on the people inside. Tatiana, I know you had a chance to meet, but we worked closely with partners in higher ed like your college to marry 4-year degrees and hospitality major that your college has, but we recognize that it's not a pathway for everyone. So this community created a hospitality certificate program. Tatiana is one of those graduates and is now working here at the Yorktown Hotel. And then finally, really with partners across this table, we've been able to focus on important needs like childcare. And this community has been able to raise millions of dollars to roll out several initiatives, not only to address access to quality, affordable childcare, but also growing the number of teachers in the childcare industry. It is the #1 reason that employers cite in terms of absenteeism. So we need to do a better job, not just here in New York, but across the country, in addressing the needs for childcare. So I know that was a lot in a little, but really all of the work that we're doing is rooted in data. The work with the Philly Fed continues to pay measurable dividends, and it has continued to create new collaborative partnerships to focus on housing, to focus on our cultural arts sector, our outdoor economy. And we're just very grateful today for the spotlight that you're helping to shine and the work that will continue here forward. And on behalf of the York County Economic Alliance, I would like to shift the discussion and ask my good friend, to my left over here, Kim Bracey, who's the president and CEO of our York YWCA, who also happens to be our former mayor of the city of York. If you could speak to how households throughout your county are experiencing our current economic conditions.
Thank you, Kevin. As he said, I am Kim Bracey, the CEO of YWCA here in York, and it's my honor to be here with all of you this morning. Households in New York City, New York County are increasingly finding themselves squeezing to make ends meet due to the rising cost of everything, from goods and services, and working parents is experiencing
would just mention a couple of other things about healthcare in the county. Certainly for our long-term care facilities, in those businesses, we are seeing, of course, the workforce issues, not just in healthcare systems, but in long-term care. And with the new staffing ratios that went into effect July 1st for long-term care in Pennsylvania, what we're seeing is, bed closures and decreased access. So that's been really tough because then patients can't, of course, get out of hospitals to go to the long-term care facility. They are with us much longer, which isn't the right site of care for them. So overall, I think public health in New York County needs a boost. We have been talking about that as a county and with our elected officials to think about what policy solutions might be out there, but really want to make sure that we are all aware that health systems really carried that burden the last few years.
So Kevin, Ken and Martha, thank you so much for your perspectives. One of the things that was mentioned earlier, but I think one thought about in the region is connected to the manufacturing sector. And so we have two perspectives in the whole game that Bruce and Tom can give us some insight on the history of manufacturing in the region as well as where they're headed before we open up the question.
Thank you. Nice to see you. My name is Bruce Small, the President and CEO of Mantech. Mantech is part of the MEP, NIST MEP network at the federal level, state level. We work under Industrial Resource Center Network. What we do, we're nonprofits supporting manufacturers. And we focus on the small to medium-sized manufacturers, of which there are 3,000 just in the National region here, and 1,000 of those plus are in New York County. So this is absolutely an epicenter for manufacturing. While healthcare is close on our heels, we are still the number one employer, the number one wages, and the number one distributor of GDP in New York County. So it is without doubt kind of the backbone of the center. On Mantech's side, when we're working with manufacturers, we help them in sales and marketing, process improvement, manufacturing technology, and their workforce. We like to say we help them top line, bottom line, and pipeline. So we're working with them holistically in their businesses as they try to grow and thrive in those businesses. You heard some of the stats. I always like to say that if it's made, it's made here. We have one of the most highly diversified manufacturing bases. There's not an automotive industry that drives everything. There's not, if you pick an industry, we have life sciences, we have pharmaceuticals, we have vehicles and motorcycles right down the street. If you name it, we are involved in it. That diversified base provides some protection in downtimes, which is wonderful. And it helps maintain us, which is a fantastic place to be. But the other thing we've been doing, in my opinion, is, and I think it's a huge challenge, I think of this in terms of land, labor, and capital, that whole economic framework. And for the past 20 years, I would say that the labor has been the only constraint that's existed among us. And in the current environment, with rising interest rates, there's certainly now constraints on the capital that's established in the tax land as well. But there's no doubt there's a constraint within capital. And the workforce we can talk about forever. There are so many partners at this table that can get into that. I'll stay on that lane. But when I look at my biggest concern in the region is we are lagging behind in the investment of advanced technologies, automation, CMMC. You kind of pick that Industry 4.0, and we're a little bit behind in those investments. And I think that is problematic on multiple levels. And even though there is a rising cost of capital, these investments have to be made because they're going to drive productivity. Productivity drives GDP, and GDP drives wages. So if you want to be able to have more career pathways that have pay scales that can afford healthcare and childcare and some of these other ancillary things, there is no doubt we need to have a highly productive workforce and a highly productive manufacturing sector. So that's, to me, the biggest constraint
of years, and that's phenomenal. And look, I'm kind of an optimist. I mean, I'm wearing a black and gold tie today. I'm a Steeler fan, so that you have to have time.
So, while I see concerns, I'm highly optimistic. It's been an unbelievably adaptable and resilient sector for more than a century. So I believe, and that's the thing that every day I wake up, kind of the relentless pursuit of what keeps me going is keep talking to manufacturers, keep having understanding. The entrepreneurs that are starting or maintaining these businesses and growing them, they continually are trying to adapt and advance new customers and partners. So I think we will get there. It's just, are we getting there fast enough? And historically, you see all these great brands, and Harley's a wonderful name-based brand in New York, but I don't deal with the Harleys as much as I deal with the smaller folks. And one of the things I want to talk about was while you see slow to adopt, you also see some huge success stories. Pan Air last week, Governor Shapiro was in town to announce a major economic development initiative. He could have gone anywhere in the Commonwealth, chose to be in New York at Conrad Company Pan Air brand. I think that says something about what we're doing in the sector. We're seeing a company advance some of those technologies. We probably all saw the OSIRIS-REx spacecraft come back to Earth with a piece of an asteroid. That heat shield was made in Denver, PA at Weaver Industries. So you see us in all of the York wall coverings, a couple blocks from here. Been around since 1895. It's a company that's adapted to new fads, new technologies, new customer bases for over 125 plus years, and I think they will continue to do so. Joseph Machine Company down the street is working with Tesla. So there's a company that no one would know unless they drove in the parking lot. They exist, and yet they are a critical partner in the transition to the electronic vehicle renaissance that's occurring in the country. So we have a ton of success stories. I want those to be the norm across the sector, and I think the number one place we can get there, in spite of a higher cost of capital environment, is making those investments in technologies that's going to drive productivity and drive your companies forward in the manufacturing sector. That's really my spiel on it, because I know Tom's got a lot to talk about as well, so I'll hand it over to Tom.
Good morning, Tom Powelson. I'm Executive Director of the Manufacturers Association. We're headquartered here in New York, but we do cover what's called South Central Pennsylvania. We have about 450 members, which equates to about 100,000 employees that are part of those areas. So, as Bruce said, this region is highly diverse from an economic perspective in manufacturing, but also in a structure as well. So we have a ton of Harley-Davidsons, Hershey Foods, Johnson Controls, BAE Systems, but we also have machine shops like Billet Industries that supplies the submarine industrial base, and Tooling Dynamics, which also supplies the green energy windmill sector. So not only is it industry diverse, we don't have any dominant industry here necessarily, but we also have a lot of different sizes of companies in that supply chain. We do have some assets, though, that you may not be aware of. We were the hub of the electronic connectors industry in this region. AMP Industries from the 50s and 60s spun out. Phoenix Contact, Amphenol Industries, TE Connectivity, top of the three top electronic connector companies in the globe are located in this region. You may have also heard about the snack food capital of the world. That's a term we use around here, from Hanover through York, Lancaster, up into Reading, Pennsylvania. Campbell Snacks, Huts, the Hershey Company, Turkey Hill, Wolfgang Candies, it goes on and on. It's a really growth sector in this region, and it's weathered the pandemic and up and down the economy very well. So a couple other things from a historical perspective. As I said, we're part of the association. We were born here in 1906, kind of at the early ages of the industrial sector. One of the founding companies was York Manufacturing, which later became part of Johnson Controls, which is still here. We also were part of, from a historical factor, you'll see murals around the city about this, the York Plan, which was a plan around World War II that networked manufacturing, both underutilized capacity amongst manufacturers, idle machines, workforce, and pooled them together to bid on defense contracts, and that became a model for the rest of the U.S. when it was fighting World War II as far as how do we organize our industrial capacity. So incredible history here. I should also note from a growth perspective, because we like to talk about the growth side, every year in this region, I think since the Great Recession, we've added jobs. I think it's like 10,000 jobs over the last 10 years. We've recovered the manufacturing jobs that we lost from the recent pandemic. We're growing in GDP, as Bruce had said as well. So a lot of good things to say. A couple of the other areas I think we'll touch on more. The labor issue is significant and problematic. Pennsylvania in general is a net exporter of population, so that's a severe problem. We're not sending our youth in high school to career and tech education like our competitor states are. We have about 6.4% of the students in career and tech ed. Our competitor states around us have 19% of those individuals in career and tech ed, which is critical to manufacturing and being successful. A couple other areas I wanted to mention, we kind of divided it up. I know supply chain comes up quite a bit, inflation. I think most of our companies have done well bouncing back on the supply chain issue. There are still some shortages out there. One of our companies mentioned about shortages of resin still. It's very difficult to get on a timely basis, but generally companies have adapted to that issue. Inflation is becoming a bigger and bigger problem for our manufacturers, especially our small and mid-size, which, as Bruce said, is the vast majority of our companies in this region. We have companies that are struggling to find working capital, affordable working capital, to make those investments. The price of automation is such that they cannot leverage affordable resources to invest in that automation, so that's a critical problem. Companies are also concerned about prices. Some of our small, mid-sized companies talked about the Fortune 500 companies coming to them with price pressure to reduce costs in an environment, as we know, that's virtually impossible to do that. So they're struggling to balance that out with their customers. So I would say generally that there's a future positivity, but one of the things I keep hearing over and over is uncertainty. And where a lot of our small, mid-sized companies are looking at uncertainty, they're not investing as much. They've definitely slowed down in hiring, although skilled labor especially, is still a major problem. That has trickled down into some slower hiring and slower investment for the manufacturing sector, especially in our mid-sized and small companies. So lots of good news for South Central PA. We talked about compared to the state, this is a growing region overall. Healthcare, manufacturing, other sectors, but especially in manufacturing, we're highly diverse. There's lots of opportunity, lots of investment from companies still, even at this point. Hershey is just putting in a new multi-$100-million chocolate factory in the Hershey area. We just located a headquarters for bus climate control down the road in York here. So those are still happening, but there has been a significant change of uncertainty that's happening in the marketplace. And, I guess one of the questions would be, how long can the companies survive these constant uncertain times? From the pandemic, the war in Europe, inflation, labor strife, price pressures, all those things keep coming and coming. And I'm just concerned that our companies at some point will pull back significantly if there's not kind of a period of time where you can catch up, take a breath, maybe make those investments in automation. So I think they've done very well and are very resilient, especially in our region. But there is a point at which that kind of runs out, maybe getting to that point. So thank you for coming today. I look forward to talking more.
This is a great point for us to pause. I want to thank you all for your comments. Before we open up for questions, we're going to take a brief break and adjust our mics so that everyone can hear us. I apologize for the microphone issue. And so we're just going to stay in our seats, and then we'll open it up to questions from the chair, President.
Yeah, but Teresa. Are they working? Okay.
Great, we're ready to go. Okay, I think we're ready to go. Thank you for being so gracious, and thank you for your comments on economic conditions across the region. Those were extraordinarily helpful. I'm going to open it up to the chair and President Parker to see if they have any questions before we open the discussion.
So, thank you, and thank you for your, pardon me, for your comments. What's really striking about all of this to me is how important it is to have a plan, and the fact that you have had a plan and have a plan. Many smaller cities and regions in the country have had a hard time, or having a hard time, especially, frankly, those that were manufacturing based. But you have, with your plan over many years, you've really focused on manufacturing as a base to build on, and it does seem to be working. I hear you about Tom, about the challenges and the uncertainty that we're facing this time. The other thing that comes, and I think there'll be a question at the end of this, but the other thing that comes out though is we're still coming through the other side of the pandemic, right? So particularly, Kim, the comments you were making, unemployment went so high, labor force participation went down, but now we're left with with a very strong labor market, people coming back into the labor market. You've got people working from home. Healthcare costs in particular is very tough on the healthcare industry. A lot of workers left the healthcare industry, and I think nationally having a very hard time to find people. So the training of new healthcare and childcare people has to be tremendously important. You mentioned, both Bruce and Tom mentioned a lot of problems around great issues to face, but manufacturing with international competition, but just also supply chain issues and inflation. So what am I going to ask you as a question? I appreciated your comments, and I wonder if it feels like your plan enabled you to come through COVID better than you otherwise would have. That you actually have a plan in place, and that's what's very striking to me. I'll just open it for reactions to that.
I think it absolutely did, Chairman. And I think the other benefit that had was we had a plan in place when funding streams like CARES and Rescue came available. So we could immediately put to good use those dollars, get them out the door quick to those who most needed it. But it really did position the community well to leverage those dollars, utilize them, strategically deploy them, and then be in position now, even a couple years later, to start seeing other funding sources come available, things like whether it has been Bloom or Fiber. It put us in position to capitalize upon them, and unquestionably it has put us in a better position today, a couple years hence, to also then not only continue the work that we're doing, but focus on the next challenges like the housing sector or childcare. So continue that kind of collaborative and data rich. And, I don't want to necessarily punt, but I also think, Tom, the work that the manufacturing community has done now for the federal TIDE program, having these plans in place and aligning all of our community partners and resources together has now put us in position to secure a very important federal designation as well.
Yeah, and based on kind of our regional partnerships and the region having a plan and working together, we were able to secure a $6.1 million project focused on workforce for the submarine industrial base for South Central PA. We have Pennsylvania's the state with the most number of critical shipbuilders in the country. The Navy's identified it. So they focused on Pennsylvania as a way to how can we increase production of those key assets in the Navy. and they've identified Pennsylvania to do that, applied some resources, and we were able to secure some workforce dollars to help focus on more machinists, more welders, more maintenance folks. And these are folks that we'll be training that are new to the industry. We're not going to be retraining existing folks. We need to bring that pool together to increase the number of folks that can get into the defense sector. So we just received that, so we'll be working on that as a region, leveraging our workforce assets, our local tech schools to do that. So it's an exciting thing based on the planning that worked.
So if I could follow up on the planning, follow up with the chair and ask, kind of what's the secret sauce, right? Why does it work here and it doesn't work other places? You don't have to criticize other places. Except maybe, my wife's family's all Steelers fans from Pittsburgh. So you can criticize them. That's it.
I want to mention the chair's affiliation with the Washington Commanders.
No, we don't.
It's a rough morning. I think it sounds cliche or cheesy, but I think it's true. It is the partners and the people in this room and so many others that are putting that plan, to work. It's very much not a plan sitting on the shelf. I mean, it really is. Things like CARES came available, rescue funds came available. We've been able to procure, state and federal support for a variety of things. We didn't sit back and wait, for those funds to, dissipate or evaporate as they tend to do. Put them to good use right away. So I really do think it's the ability that we've had to align a lot of disparate parties and people and organizations, really for the kind of North Star that we've been after, which is just enhancing shared widespread prosperity in this community.
Just if I can echo that, so many smaller communities have really suffered from losing aspects of their manufacturing base, and you kind of made it a centerpiece of your strategy not to let that happen. It seems to be working. I get it that there are many, many obstacles to that, but it's pretty striking that this can be really at the heart of what you're doing here.
Can I ask you to illuminate a little bit more granular and ask about the digital project that you mentioned, kind of broadband, and broadband is now kind of critical to work, critical to school. Can you talk a little bit about the gaps that exist in terms of broadband access in the region and how it's impacting the economy?
Sure. Thank you, Teresa. We're a county of 450,000 population, 900 square miles. So it's a pretty geographically large county, an hour drive, hour plus, county line to county line. In 2020, when we were doing our economic plan, CARES funding became available. We, with support of our county government, were able to do a countywide connectivity study to really lend data to anecdote, right? We know if you're driving around and you lose cell service or you're in a pocket where it doesn't necessarily have broadband, we were able to get real objective data. So there are absolutely pockets of York County and rural York County that are upwards of 70% without federally defined high-speed internet. And in York County, it's really twofold. It's infrastructure in rural parts, and it's affordability and access in urban areas. So there are pockets in our York metro, in the city of York, or in Hanover Borough, where it's upwards of 50% don't have access to high-speed internet. So we've been trying to bridge the digital divide in York County, and again, through support with county government, through rescue and CARES funding, we've now have $27 million allocated. And in terms of a fun project that we didn't let sit on the shelf, we knew this existed. We did the county study with CARES funding, which was under a time crunch to spend. We opted to just build a middle mile network under a county asset, which is our Heritage Rail Trail. It's a 16-mile bike ped path that starts in the city and goes to the Maryland line. 40 years ago, the planners at the time buried conduit underneath it. It's a county park. It's owned by the county. We ran 16 miles of fiber underneath it, put up 2 wireless antennas, and are pushing out a free Wi-Fi signal. That was a proof of concept project that showed that we could do it. The county could own this asset. And now we're in a second phase where we're building out over 100 miles of middle mile fiber connecting parts of southern York County. So really Hanover to the Susquehanna River, Route 30 to Maryland, that the county will own, and then work with private operators to then serve as an ISP to better connect homes and businesses. That tackles the rural element of it. The urban affordability and access still exists. And in that, our county government allocated $5 million to build a free basic need wireless network in the York Metro and the Hanover Metro area. That's underway, and that'll be up and running, hopefully in 2024. So it's not the type of network that a resident in the city might stream multiple devices or binge watch on Netflix. But if you need telehealth, if you need a virtual meeting, if your child needs to do virtual learning, it's a resource. And so, again, credit to having an economic plan that said this existed, doing further study to lend objectivity to anecdote, and then having resources available and having a host of partners, community organizations, and elected leaders that said, let's invest this wisely.
Thank you. Any other questions?
Yeah, Kim, I was very curious about, you talked about one side of the equation on child care. Obviously, the demand is very large. But what's driving the cost? Some of it also is availability of labor. Can you speak to that? I mean, what we hear in other places is it's just hard to find child care workers.
The cost, again, for the individual families, everything is driving those costs, right? The cost for goods and services just to survive as a family is part of that. And for a family to decide what they are going to pay for, I think are some of those things that come into play. The cost to run an operation obviously is everything. I'll say the regulatory parts of it, staying compliant, having enough staff, the ratio, being mindful of making sure everyone is able and trained properly as well too. So we are very happy to be part of those sort of plans because childcare, you can't have manufacturing without having a means for the children or care for them as well too. So the leadership YCA to be inclusive with childcare is critical to this, and definitely thinking of those costs and those things that affect the family just to get by every day. We appreciate being part of the conversation and being in those studies.
I've often heard that child care is the workforce behind the workforce, and I do think that's a true statement.
Indeed. So thank you for those perspectives on economic conditions. If no one else has any other comments, I'm going to turn it to President Harker to move the conversation to our workforce.
Yeah, so we want to pivot to, that's what we were just talking about, workforce, and continue to talk about that. As you know, the Fed has a dual mandate, stable prices, we're working on that, and maximum employment. The way I think of that, and personally, and the chair may have a different view, but is obviously that everyone who wants a job can get a job. But then on the flip side, from the employers, everyone who wants to fill a job can find an employee, right? So it's both. It's really both. So as we think about this and the kind of programs that are necessary to fulfill that mandate, it really needs outreach. We need to bring more people off the sidelines into the economy, more people working that in jobs where they thought they probably couldn't work, right? Or they didn't have the skills to work. It's starting to get more people into the right places with the skill sets they need to have those fulfilling careers. And for the employers then to have those employees who want those fulfilling careers and have the skills. So, we met with such a great person this morning, Tatiana, to my right, to talk about the program here, the hospitality training program, and how it really does meet that need of bringing people into the workforce. So I want to turn to you, Tatiana, and ask, how did you hear about it? And as you think about the program, what challenges did you have in finding employment before the program? And what's happened since?
Hi, everybody. My name's Tatiana. So I heard about the John Lambert training program through a small business program that I was doing through the YCA with Kevin and Suli. And that's kind of how I started doing this small business program, and then that's when I heard about the John Lambert program, which is a program that helps you, depending on which department that you're looking to go into. It could be either housekeeping or in the kitchen or front desk. It was a program to kind of help you start that journey on what to expect, what the employer is looking for. So I ended up taking each course that they had, so housekeeping, front desk, just kind of to get all those things under my belt. And I knew it was something that I could take, whether it not be here at the Yorktown, it's something that I could have under my belt or in my resume that could help me in the future as well. But I ended up doing this program, and I got my certificates for each program that they offered. And I really think that it helped me get my foot in the door. I don't think without those certificates that I got, I would have had the opportunity that I do now. So I started here because of the training program. I did my interviews, and I got my foot in the door. So I started here as a server in February. And I quickly worked my way up from everything. So I'm currently a manager, and I'm hoping to go into the sales and marketing department here with the hotel. And as far as any challenges, I was seeking employment, but I was kind of looking to also work for myself. That's why I got into the small business program first. So I don't know how difficult it would be to seek employment right now, but I know a few people that also applied to the hotel that didn't make it to an interview. So I think the John Lambert program definitely helped me start my way and my journey into the hotel. I don't think that without it I would, have the opportunity that I did today.
Yeah, it's a great program. We heard earlier that the program is named after an employee who worked here at the hotel for 60 years.
Yes.
I mean, what an amazing story, right? 60 years. So what a great testament to him, his family, and to the program. So let me turn to Keith. I mean, in your story at Harley.
So my name is Keith Forty, and I work with Harley Davidson. Been there just about a quarter of a century, which I find hard to believe. So about half the time they've been in New York. But I was a part of an employment readiness program as well. And what I lacked when I took a look at this motorcycle maker in the sky that was here in York is I can't be part of it. What that program did for me was give me the skills that I needed, the knowledge that I needed, and I think most importantly, the confidence. And that's confidence in that knowledge, confidence in those skills, and just straight up confidence to sit in a room and talk to a panel of people, which that was the first time I had ever done that, a 5-panel interview, and have the confidence to tell them why I would be a good fit for their organization. And without that program or that availability to strengthen the workforce and make sure that they can align with what manufacturers need, which the group over here does a great job of making sure we're aligning not only as a manufacturer, but as an employee base, as a labor pool. When we have that connection, that's where the magic happens.
So let me pivot to Jesse to talk a little bit about your work and what you're hearing and seeing with respect to workforce.
Yep. Thank you for the opportunity to share. We welcome you to York. We're proud of our community. And before I jump into the workforce, I just have to say, that's probably one of the things I'm most proud about is the collaborative nature of everyone around this room. And it truly is what makes this community so strong. We're transcending the real partisan fault lines that can divide us. Eagles, Steelers, Commanders. If we can get past that, we can do anything, right? But Harley, we have amazing training programs here at Yorktown. We've got community-based organizations and higher education in the business community. We were talking with President Harker before. What are the things that if a community can transcend, we can do some really great work? And it's getting past the two barriers of who gets the money and who gets the credit. And I think this community, I've been really proud around. It's not fighting for the money or the credit. It really is truly collaborative. I think, in talking about the workforce, I think the underlying element in the dual mandate that you all have is that full employment. And it's been well documented that one of the biggest barriers that we're facing right now, one of the key issues that most businesses are facing, both here in South Central Pennsylvania and across the country, is a a lack of workforce, right? So as the CEO of the Workforce Development Board that serves an 8-county region here, which includes York, but also 7 other counties, it is our goal to invest in, evaluate, and advance high-impact workforce programs that drive economic mobility. We envision that this region can be a place where the opportunity for prosperity and growth exists for all people, both for job seekers and businesses. And so part of what we do as a workforce board is we're looking at those individuals who are on the sidelines, right? So let's carry the NFL metaphor a little bit, right? It's somebody who is not in the labor force. They're on the sidelines, they got their helmet, their pads ready to go, and they want to get into the game. So the Workforce Development Board, our mandate is to get those individuals the skills, knowledge, training, and education to get into the workforce, to be productive members of our growing economic community. So what are some of the barriers that we see? As it's been well documented, the demographic droughts are difficult to reverse. An aging population across the country, low birth rates. Quick anecdote, this is my first day back from paternity leave. We just welcomed our 4th child a couple weeks ago. So we are doing our best to keep those birth rates as high as we possibly can, but it's going to take more than one family, right? So these are structural problems that are going to be challenging for us to navigate. So in a world in which there are structural limitations to the size of the workforce, that really is, not to borrow the term, but it's lower for longer in terms of the number of people in the workforce. How do we make that workforce more productive? And so the biggest barriers that we see is that really this should be a golden age for workers. When we consider that there are often more jobs available than there are available workforce, we're seeing that with rising wage pressure. This should be a golden age for workers. And so what is motivating workers, both here in New York and across the state and the country, is really pay, pathways, and purpose. And I would probably add a 4th one in there, the ability to pivot. So pay. What are the wages and what are the opportunity occupations, such as manufacturing and healthcare, that will be able to support my family, right? That family-sustaining wages. So we use a lot of that family-sustaining wage in MIT's living wage data to say, are these opportunity occupations that will really help workers find pay? Pathways. For some of our higher education folks, if we have a college graduate coming up in May, what's the likelihood that that recent college graduate will need no more training, education, or professional development over the next 40 years of their career, right? 0, right? So we need the opportunity to build really strong pathways. One thing that includes is the agility to be able to move and be nimble as there are changes in the labor market. I was thinking about, Bruce and Tom, your comments about manufacturing, 4.0 industry. How much will manufacturing change over the next 5, 10, 15 years with AI, automation, robotics? We need the pathways with our higher education and post-secondary partners to be able to build the agility into those pathways. And then purpose, right? Workers want to be a part of something bigger than to just be a cog in the wheel, right? I think about Harley and the incredible impact it's had on the community. So pay, pathways, purpose, and then that ability to pivot, right? To be able, over the next 40 years, to get the skills, knowledge, and ability to adapt with the changing times. 2 other real quick comments here is, one of the things that we see is that, and we've noticed this a barrier with workforce development, is that there's this unfortunate dichotomy of either college or career, right? And we see this with higher education, I'm sure, seen this significantly, but even in parents and guardians, so this idea of my kid's going to college and that's the only pathway, right? It was 13th grade for me. That was just the next logical step. I didn't know there were other options. But I would like to say that if we as a community can look at that instead of college or career, it's college and, right? The ability to source a skilled talent workforce both through bachelor's degrees and in what we would call skilled through alternative routes, or STARS. And this is an acronym that Opportunity at Work, which is a great organization, has really piloted. The skilled through alternative routes, apprenticeships, on-the-job training, co-op programs, career and technical education. There are many ways that we need to build a skilled workforce in alternative routes from bachelor's degrees. I'm the beneficiary of a bachelor's degree. I think many of us here are in this room. But in order for us to solve the underlying problem of not enough workers, we need to source this through alternative routes. Last thing I would say is we have some great industry partnership programs here. Tom and I have been working together for 7 or 8 years on a number of industry partnership programs, grant funded through the state, where we put employers at the center of the table, so to speak, and let employers drive the conversation around what they need, what's valuable, and what the skills, knowledge, and training is really valued in the market today. Then the economic development, workforce development boards, and higher education respond with that demand-driven approach. And I think that's a real best practice that we've done a great job of here in this region, and I think it's replicable across the country to put employers at the center instead of the train and hope that those graduates can perform in the market. It's putting those employers at the table and saying, this is where we need to invest. So there's a lot there. I'm really excited, and I love your optimism, Bruce, about this region. My wife and I are transplants here. We moved here 12 years ago. We're just up north the road on 83 a little bit. This is home. This is a great place to live. It's a great place to work. It's a great place to raise a family. Great institutions, great businesses, low cost of living. So the story of South Central Pennsylvania, I think, will be a lot of the story of American growth. We love Philly and Pittsburgh, but what's happening here is really exciting. Yeah, absolutely. So at this point, speaking of higher education and our friends at Harley, Demetra, David, and Tom are going to talk a little bit about some of the ecosystem that we've built here, a great group of partners, including our business community, that's so instrumental in driving this conversation.
Hello, Demetra Middleton. I'm Harley Davidson, York Final Vehicle Operations Plant. We actually just celebrated 50 years here in York. And so again, excited to be at the table and have these partnerships with the various organizations here. I just moved here in 2019, so I'm not originally from York, but I found that York is a great place to live, work, and play, and a lot of it was that initial connection we made with York County Economic Alliance Council. So a few things that we've been able to partner with them for example, the job fairs. We participated in several of our job fairs at the York Revolution Stadium. We've been able to communicate that, again, Harley-Davidson, it's a brand name that everyone knows. We make the world's most desirable motorcycles. Everyone wants one, right? But a lot of people don't realize that some things we've done to respond to the market is you only have to have a high school diploma or GED or 1 year work experience anywhere. We will train you as a production technician employee. We have a 3-shift operation. We run pretty much 24 hours. We're a union shop. So we have a lot of great opportunities. And through partnerships, we've been able to share those opportunities. With us not being the only manufacturer, as we said here, and a lot of competition, we found that working together, not only with the Manufacturing Association, ManTech, the local colleges, but also the Penn Airs, the bus climate control, RHI Magnesita, we found that we all need the same thing. So how could we work together and be collaborative in offering those opportunities to our employees? At Harley, we found that a lot of us needed welders, for example, in this organization. So we've been able to partner with the Manufacturing Association, with York County School of Technology for the past 4 years. We've been sending our internal employees for free training because of that to be welders, and that's been a successful internal career development program for us. We've also been partnering with the Manufacturing Association on our maintenance apprenticeship program. That is another topic when we get together in a lot of our conversations with other manufacturers. We're all looking for these same skill sets. So we've been able to work together to move forward with that. I know when you were mentioning about college isn't the only option. I laugh all the time because my father worked 30 years in manufacturing, retired from there, but college was the only opportunity he ever discussed with me. So once I got into manufacturing, I was like, Dad, you never told me manufacturing is a great career. It's something that I want to make sure that I share. So with my children, I was able to say, hey, this child, college was a fit, but this child, it wasn't. So we were able to talk through, and because of the partnerships I had, he was able to get his HVAC certification through the York County School of Technology Adult Education Program. So again, we have all of these great partnerships and opportunity. Another thing that with the Welcoming Workplace Initiative, that a lot of us were able to come together as partners to bring together conversations where you have these various organizations where we can talk about how York is a great place to work, live, and play. And it has become a consortium of conversation where you can get more information about making sure that your workplace is inclusive, there is belonging, and you have those other organizations that you can learn from. At Harley-Davidson, it's a part of our strategy that inclusive stakeholder management, it's who we are. But I'm still able to talk to a Pioneer, to Bus Control, RHI Magnesita, to find out what are they offering, and businesses of all sizes have that opportunity where we can collaborate through the Welcoming Workplace Initiative. Some of these I'll just add that, again, has been a great partnership for us. Partnering with York County Economic Alliance, we currently have a child care survey that we're doing, and I work closely with the YWCA as well. And so that has been a challenge. I know Wellspring has the same challenges. When you have a 3-shift operation, 3rd shift child care is a big thing. And so we've been able to work together to try to figure out, okay, what can we find out what York needs as a community, and how can we work together to support it, because Harley-Davidson is a big name, but we can't do it by ourselves. So we need those partnerships. Same thing with transportation. That's another big one for us. We've been able to work to talk about what are some transportation options for our employees in the workforce.
Chairman Powell, President Harker, thanks for being with us. My name is Thomas Burns. I'm the president at York College of Pennsylvania, and I'm the newbie around the table. I just finished my 3rd month here, and so part of my role is to say that I'm here because York is a place where I felt I could thrive, and it's a community that is built on collaboration and cooperation. Everyone around this table has a connection to York College, and York College has a connection to everyone around this table. And it's lovely to be at a place that is interdependent and collaborative and cooperative. As Demetra said, part of what we all need to work on is the idea of attracting and retaining talent. And part of the higher education portfolio that David and I work in is really helping to attract people into our community, helping train them, and helping them stay here. So for the college, it starts with a program called YCOSP. It focuses on students who are at William Penn High School, which is here in New York City, and is an opportunity for, regardless of financial circumstances, chance for students to come to college with all their expenses covered. And it is meant to give them an opportunity to engage in higher education, if that's what they want to do, to change their potential and opportunities here in York, but also to change the pathway their families are on. And so it's a wonderful opportunity to bring people in and help them find their place and their purpose, and then help them develop skills and opportunities that will make this a richer workforce area. We're also engaged in working with the community to help identify data sources that can help the community make good decisions. So we have a Master's in Public Policy Administration, started recently because we recognized that the community itself had lots of data and lots of information, but didn't have a place to collect it and to gather it and to use it to make good decisions. And so part of our role as being sort of a politically agnostic entity is to help bring that data together and provide it to the decision makers so they can use it to make good decisions about their future. Of course, we're really interested in job placement and job development for our students, and so we spend a fair amount of time focusing on real practical, hands-on education at York College. So we're heavily invested in internships and co-ops and study abroad, and an opportunity that the Yorktown, where we are all meeting, has provided us as a community hotel was an opportunity for our students during the development, the construction, and really the operation of this entity is to bring our students into those conversations and have them sit with the people who do the work and do the business, learn alongside them, and then ultimately see this as a career opportunity for them. And so we have many graduates recently who have come on to work at the Yorktown as part of that process. Right outside these windows, you can look across the street and see the Gunter Smith Center for Community Engagement, named after my predecessor. But we put in the center of the city a location that brings together community organizations, nonprofits, provides training and conversation partners to help make sure that as a community we are discussing the important topics that matter to all of our success. And so these are conversations around group violence intervention and other opportunities where we can bring the shareholders, the stakeholders together, talk about the issue, and then develop solutions together, because together we're going to do this well. If we do it as a separate entity, it doesn't work. And so you've heard that around this table all morning. And then last but not least for us is the importance of taking the concept of career and professional development into the development opportunities. So the J.D. Brown Center for Entrepreneurship is our incubator for new entities who want to establish new businesses in the York County area, but then it transcends itself into a place that we've developed called the Knowledge Park. So the Knowledge Park is sort of the next step for those incubated companies where we've built a facility right next to the college where we bring in our business partners who want to work with the college faculty and college students and college staff to help create and develop new ideas that then can either form new companies, new jobs, new opportunities, but it serves as a second stage incubator. Our partners at WellSpan are also developing a production facility. They're a well-established company but they need more space. So we can provide that space, but also an opportunity to collaborate with our scientists, our engineers, our communication specialists to develop training and opportunities for their faculty and their staff. And so what we see ourselves, David and I, are as places that can incubate, attract, retain, and develop new ideas. And I think David's going to spend a little time talking about the Launchbox program that Penn State York developed.
Thank you, Thomas. My name is David Christensen. I'm the Chancellor at Penn State York, and I welcome you here to the York community, Thomas. I look forward to working with you as a partner. Penn State University was founded in 1855, and in 1863 it took on a mission of being a land-grant university. What essentially that boils down to is it accepted the responsibility of driving economic prosperity. Historically, that has taken the form of students in classes, preparing a workforce for the future, but a profound change took place about 9 years ago when a previous president, Eric Barron, created the mission of the Launchbox at Penn State University. The Launchbox is the notion that we bring our expertise outside of our university community and into the surrounding community to engage with individuals who were not Penn State students. So he was very interested in tech transfer. It started, first of all, at University Park, but extended to all of the 20 Commonwealth campuses. We were the last campus of the 20 to get a Launchbox here at York, and that was just 2 years ago during COVID. So each of the Launchboxes adapts to the local needs of its community. So for instance, in Erie, there's a focus on manufacturing, and so advanced manufacturing is the focus of their Launchbox. Here, there was a rich ecosystem of entrepreneurial resources already. We felt the area that was most underserved was early stage entrepreneurship. So working with individuals on proof of concept, developing prototypes of products, proof of relevance, customer discovery, minimum viable products, and so on. This was before the Bloom Business Empowerment Center started, and it is a very similar mission, and we look forward to working with partners just like that. Oftentimes we find individuals who are at a different stage of their entrepreneurial development, and we'll send them to the different resources in the area. One example that I could give you of work that has been done was, incidentally, a Penn State York business student, an individual who wanted to create a bisexual dating app. There was Grindr, there was Tinder for other communities, but there was nothing for bisexual dating. So she came up with the idea of Binder, B-I-N-D-R. And you can actually download it right now if you want to. She came up with the idea. She worked with our Launchbox community, a couple faculty members who shared their expertise. We connected her with a local IT individual, and now they've created this app, and it's doing very well, and it's getting a lot of notice. So the Penn State York Launchbox is great. We are part of this community of Launchboxes throughout Penn State, throughout the community. We're a portal to other resources throughout the university. Now, you might be familiar with the Brookings Institute study a couple of years ago looking at technology transfer within Pennsylvania. And they looked at the universities, and they looked at the ratio of research expenditures and patents, and Penn State University was not performing very well. We do have $1 billion annually in research expenditures, but about 95% of that is located in a rural county in the middle of Pennsylvania, far from Pittsburgh, far from Philadelphia. it's felt that we could be using the launch boxes as this connection to the greater university resources. The challenges we have is making that connections because the launch box initiative, something new, we don't have the resources, we don't have the expertise of the faculty, but we need to figure out a way to make this system work more efficiently. So finally, I'd like to also mention that in addition to the launch box, we do focus on developing skills within our own students outside of the the academic skills you get within a major. We focus on helping students get ready for the professional workplace through training on innovative thinking, resilience, emotional intelligence, and so on. So we're very proud of these innovative programs, and frankly, I think this is one of the ways that Penn State York does contribute most to the greater York community.
Thank you so much for that. This is a really great conversation on workforce and education. I ask the chair and President Hunter if you have any questions of the various workforce stakeholders.
Once again, I find myself wanting to comment, so this is, it's really, the word that comes to mind is mindful, how mindful all of this is, the focus on developing people and developing opportunities for them. Jesse, you pointed out that should be a great time to be an employee here. We have 1.5 job openings for every unemployed person. We have what appears to be a structural labor shortage and lots of opportunity. So our main part in all of this is what we all desire at the Fed is a sustained period of strong labor market conditions. When you have a sustained, the record is clear, a long period of sustained labor market conditions, lots of good things happen. You get real wage increases. You also get things like broadly over the country, people are looking to find more people and getting them into the labor market, including visiting prisons and starting to work with people a year before they get out. So, and actually it turns out that as an expansion gets longer and longer, more and more of the wage gains actually go to people at the lower end of the wage spectrum. So these are really beneficial things. To have that, though, the record is also clear that we need price stability. Price stability is just a critical piece of bedrock for the overall economy over the years. So, and that's why we're very focused on restoring price stability and then having it over a long period. But again, this is a great time, and many of the programs that we also hear wherever you go in the country, where there are entrepreneurship programs, and what you characterized as what was the program you had a nice description of that would enable you to work. Employee readiness program. Yeah, those really do seem to work and pay off, and this is a message that obviously it seems you and York have gotten long ago, and so it's very encouraging.
Yeah, I would just add to that I think about the collaboration you have that you're describing. You wonder, it's very difficult for very large cities to do this. Small cities don't have scale. They seem to have kind of a sweet spot. Am I seeing that right?
Yes.
It's unusual. I mean, you're just about the right size, right? You're that one bed in the story. But it's just about the right size where you know each other. You can work together. Whereas in larger urban areas, it's a little tougher. That really struck me.
The point Keith made earlier about just being aware that he could get a job at a brand corporation like Harley Davidson. Jesse, can you talk a little bit about how city residents become aware of some of the programming opportunities, some of the job opportunities in manufacturing? Like, what's that connection point for a typical worker?
Yeah, how do you break down that view that these are not jobs I want my child to have?
Yeah, that's a great question too. Just to answer that real quickly. So, and this is anecdotal, but I think over the past 10 or 15 years, we've seen a market change. That pendulum was swinging to four-year degree and or bust. And I think it has to some degree, and I'm looking around the room for some confirmation, that I think it's come back to at least a little bit of a stasis around there are other ways. I still think that sensibilities and the dichotomy, I think, of parents who want four-year degrees is still a hard thing to break. With regards to job seekers across York City and York County, I think it really does take a productive network of businesses and community-based organizations, economic development and workforce development boards to be out in the community. So for instance, the workforce development boards are authorized under the Workforce Investment and Opportunity Act to run American Job Centers. Historically, we have just had American Job Centers in one building and say, job seekers come to us. For the past couple of years, I think it was motivated a lot by the pandemic. It's let's build community access points in 24 or so places across York City, in rural areas, and let's go to where the job seekers are. And one thing I'll say is that when we talk about those that are on the sidelines, another demographic that we keep our eye on is the ALICE population, right? The asset limited, income constrained, the employed. Well, if those individuals are working, they probably aren't going to come to our American Job Center during 9 to 5. So we need to, it's prohibitive for us to say, just come to us 9 to 5 in this building. We need to be out and build community access points at health centers. We need to be doing on-the-job training at manufacturing facilities. We need to be doing English as second language workshops and courses on business premises. So we need to be out in the community more to make sure that we're serving that ALICE demographic and those that are on the sidelines. So I think to that point, we can't just sit in one place and hope people come to us. It needs to be out in the community.
So last area we want to pivot to, I want to be cognizant of the time, is really around access to capital. This came up in a couple of places, access to capital. You know, the Fed has been really grateful for the work we've been able to do with all of you through our 2021 Rock Cohort program in working on this issue. And I know, David, you mentioned Floyd's work at the Bloom Business Empowerment Center. So could you share some of the work you're doing there and some of the exciting things about the CEO product?
Sure. Thank you again for the opportunity. And as you mentioned, really, we are so thankful for the relationship with the Federal Reserve Banks and the opportunity to be part of the Reinventing Our Communities initiative in 2021 focused on small business recovery. And we were so amazed and we took so much from that program that we applied again in 2022 on the workforce initiatives. So we're going for the punch card effect. So hopefully the next one will be continuing the relationship.
Yeah, that one for you.
Okay, thank you. Thank you. But really the opportunity to be part of that program and connect with communities across the country that are similar in size, similar challenges, really be able to share some of those best practices and establish the relationships where at any point, really the sense of camaraderie and as we're all talking about today, collaboration, it's not just in York, it's not just in central Pennsylvania, but across our country and really supporting to drive that economic change. So through the ROC cohort in 2021, which coincided with the implementation of our county's economic action plan, we had great data in front of us that showed that York County lagged the business birth rate when it came to women, individuals of color, and our other underserved populations. So looking at the opportunities to come from that, of where can we really put our resources, continue that collaboration, not just on workforce, not just on housing or childcare, but again on the sense of entrepreneurship, because many of our entrepreneurs, many in this group that you'll get to hear from, all have a sense of passion and desire to help their community. So how can we empower them? Through our Bloom Business Empowerment Center, where we've been able to offer, we launched officially in February of last year, and through that have been able to offer free educational for entrepreneurs in English and Spanish at a local community center, Christmas Attics that we shared earlier, where we connected with Tatiana, who that was able to take the Johnny Lambert hospitality training courses and really help that be an opportunity to grow the awareness in the community. Through that, we've also been able to award, be a source for capital when we're looking at emergency needs that a business may have. Whether it's not enough to go and pursue capital by way of a loan, but where's that emergency fund? So through the classes, we're helping entrepreneurs be financially ready to pursue that step into entrepreneurship and plan, but also support them through our Bloom grants, which are micro grants to support emergency needs, marketing projects, and for any other larger needs. We are incredibly thankful to be able to partner with the state and deploy their SSBCI funds, as well as our own Bloom funds to provide our loans speaking of the great entrepreneurs here in the room, I would love to turn it over to Michelle from Lux in Maine, and then Sandy from Fat Pat Brewing to share about some of their experiences through Bloom and also their incredible journeys as entrepreneurs.
Hello, everyone. Thank you for having me. I am Michelle Wright from Lux in Maine. Sorry about that. I am Michelle Wright from Lux in Maine. I have been in business now for 8 years. I just celebrated yesterday. Yesterday, October 1st, made 8 years being in business. Being a business owner in York is definitely taught me so much, especially back in 2020 when everything was closed. I had to close my business due to the pandemic like everyone else. But also during that time, a month after we were closed, I endured a fire at the building. So I also had to pivot through those things, and that was very challenging for me. So going without, going from a 2-income household to now a 1-income household was definitely a struggle. But through that, we have definitely made it, we've overcome. And I think I could speak for every entrepreneur out here that, it's not about where we are, but where we're going, and just the tenacity that we have to keep going in spite of the challenges that are ahead of us or that we face today. And with that, I decided to do a ribbon cutting when I reopened my business, and Bloom in Downtown Inc. has been just a great resource for me and my business. It has opened up many doors and opportunities for me. I have been able to be at a platform such as this today, and other things that I have had the privilege and honor of speaking with other people like entrepreneurs such as myself. I do believe that working capital is very important for entrepreneurs just like me, because it helps us to be able to create jobs and opportunity for people and businesses, and also being able to survive, and being able to continue to have products and that nature. Just recently, I had a client call me and tell me that unfortunately, because she normally comes every 2 weeks, that she will no longer be able to come as often as she could because of inflation and prices and different things like that. So it's been a challenge for her to be able to do her upkeep and her maintenance of her personal care that she normally would do. So a lot of people are definitely facing some challenges in this moment, but I do believe that at some point we'll be able to get through this and it'll be better on the other side of this. As far as the training, like I said, with Bloom, they have helped me as far as education. They've helped me, and Suli has been a tremendous asset to my business and just helping me to propel, and even being able to do speaking. Like, I never thought I could be speaking, with a large audience such as this, but I am truly grateful for the opportunity. And I do plan to expand my business at some point. Right now I am in a small space, and it is me and another person, but I would love to be able to offer a different variety of services, such as spotlight services. I have the vision, I have the business plan, thank you. But just being able to have access to capital would really, really help me to be able to propel my business to the next level. So I would love to be able to do that at some point. Right now, I've kind of put a pause on it with everything that's going on. But at some point, I know that we'll be able to do so.
Thank you, Michelle.
Yes.
Two mics to choose from.
Hi, I'm Sandy Bile. I'm the owner of Fat Pat Brewing Company over in Hanover, so we're in the New York County area. Challenges to opening. I would say COVID was a big challenge. Opening is difficult anyway, but COVID really threw us a curveball. I planned to open March of 2020. That did not happen. We opened 15 months later, I already had a full-time employee, so I had to pay him through all of that. I ended up having to shift some funds that I was going to have contractors do things. I had him do different things. So there's a lot of, like you said, pivoting that had to go on. But things have been great since then. I would say this year is a challenge with the continuing, I'd say the lingering effects of COVID. So we have inflation, we have expenses, shipping has at least doubled. All of my supplies, because of shipping probably, have increased in price. So it's difficult. I'm trying to maintain prices because craft beer is expensive compared to other beer. But, this is the challenge that we're facing. Right now, another thing that's really affecting me is the cost of money. I have a line of credit. I have a credit card. Those things, I get notified pretty regularly, about every 2 months, that my interest rate is going up again. And that's been going on for over a year now. So that makes it difficult, but I have plans to expand as well. At the end of last year, I was really looking into locations for a second tap room. But I really pulled back those plans and just hunkering down and sticking with this location and trying to build the business there. I do still plan on looking for another opportunity in the future, but just not right now. I did get some help from the Bloom grants. That was very helpful. It allowed me to increase my customer base. Hanover is looking to be a trail town, and we are very near where the trail will come into Hanover. So I had, as part of the grant money, I used it to get a bike repair station because we have a lot of bikers that use the trails, and it's right behind our building. It's attractive, and we have it on Google Maps, and you can see where it is, and we have a lot of use. Even without the trail connected yet, we have a lot of people using it, which is really nice. And I also used it to get a stair lift. We have a rental space below our tap room, and there was a half a flight of stairs that handicapped or elderly people could not get down. So we got a stair lift, which is great. Now just one person can help people go down the steps, and it's worked out very nicely. But yeah, I'm glad that all the support is here in your county, and looking forward to the future. Because after the inflation and the rough times, then the good times come, right? That's what we're waiting for.
Thank you for another round of really inspiring comments.
Yeah, and I'll just, I know we're at time, and I know you got to get back running businesses and figuring out workforce solutions and childcare. Really, I just appreciate you taking all the time here today. This is really interesting. I mean, I can take a lot of notes, a lot of things to think about. I know the chair shares that view. And so on behalf of the Fed,